Good evening, everyone. So it's cyclone here. Hope you all got your like this mighty 50. Yes. So quickly we will try to complete today's discussion. So we are left with few topics in customs. So look into procedures under customs. So in this procedures under customs, mostly we will be getting MCQ only, and that to one MCQ only. If not, maybe one or two possible questions are there. First one, the procedure with respect to import. This procedure is between the exporter, importer and the person in charge of the conveyance, that is master of the vessel. So the first step is that the exporter of the vessel, the exporter of the goods will hand over the goods to the shipping company, and as soon as the goods are handed over to the shipping company will give bill of lading. That bill of lading is a document containing the information about the goods which are there with the shipping company, and this is document of title to the goods. That bill of lading will be given by the exporter to the importer, and thereafter the master of the vessel, person in charge of the vessel, master of the vessel will bring the vessel, and arrival manifest and import report will be submitted. So this arrival manifest, that is usually in case of vessel it will be called as import manifest. In case of aircraft it will be called as arrival manifest. In case of vehicle it will be called as import report. So here import manifest will be submitted along with that arrival report, and the customs officer will verify this import manifest and will be granting entry inwards. As soon as the entry inwards is given, the master of the vessel can dock that vessel and can deliver the goods to the port authorities, and thereafter importer will file a bill of entry for home consumption, and the goods will be verified by the customs officer based on the bill of entry and will collect the customs duty. Then out of customs charge order is given to the importer. So the importer, if he got out of customs charge order, which means that he has paid the customs duty with respect to the imported goods, and the importer will hand over the bill of lading with the master of the vessel, for which master of the vessel will give delivery order. So this out of customs charge order and delivery order will be handed over to the port trust authorities, and the port trust authorities will release the goods. These are the steps involved. And in case of aircraft, what will happen? This bill of lading, wherever we have seen, that will be changed to airway bill. In case of vehicle, the bill of lading will be changed to railway receipt or lorry receipt, and then this import manifest will be changed to arrival manifest. Then in case of vehicle it will be changed to import report, and this concept of grant of entry inwards we don't have in case of aircraft or in case of vehicle. We don't have this concept. So say this. So all the import and export procedures under the customs or through customs common portal, that is icgate.gov.in. In case of import by aircraft, 2, 3 and 9 is replaced with airway bill. Import by vehicle, 2, 3 and 9 is replaced with lorry receipt or railway receipt. In case of aircraft and vehicle, grant of entry inwards is not required for arrival, but required for the purpose of unloading of goods. I mean, there is no concept of grant of entry inwards, but we need to file that arrival manifest and import report for the purpose of unloading of the goods. Who is person in charge of the conveyance? The master of the vessel in case of vessel, and pilot in charge in case of aircraft, and driver in case of vehicle. Place of arrival, it should be in the customs port in case of vessel. In case of aircraft, customs airport. In case of vehicle, land customs station. However, vessel and aircraft, it is allowed to land at any other place if compelled by accident, stress of weather or other unavoidable reasons, and they need to file import manifest, arrival manifest or import report, and import manifest should be filed before the date of arrival. Arrival manifest also should be filed at any time prior to the date of arrival, but import report alone can be filed within 12 hours after arrival. And in case of import manifest, arrival manifest, it should be in electronic mode only, whereas in case of import report it will be manual, and for belated filing the penalty will be up to 50,000. In customs everywhere, for the breach of provisions the penalty will be up to 50,000 rupees. Then in case of electronic, the principal commissioner may allow manual filing also, and they need to file a passenger name record information along with IM, AM or IR, and for this belated filing penalty up to 50,000. passenger name record information will be with respect to the passengers who are present in the conveyance. Then in case of import by vessel, goods shall be unloaded only after obtaining grant of entry inwards, and goods go to the custody of a person called as custodian under section 45, and the custodian shall ensure safe custody of the goods. Suppose it so happens that there is pilferage, the custodian is responsible to pay the dues. In case of pilferage, custodian shall be liable to pay the duty. Only those goods specified in IM, AM or IR should be unloaded. Goods should be unloaded only at the approved place, and it should be unloaded under the supervision of proper officer. For unloading, if small boats are required, then he shall obtain a boat note from the customs officer. That is, whenever the ship is anchored at outer space, from that space to the port, the goods are transported through small boats. They will be collecting lighterage and bar charges also, and those boats has to accompany the boat note, because otherwise these goods are considered as smuggled goods by the coastal guards. And if unloading goods is on holidays or after office hours, some extra charges is payable, that is merchant overtime charges. That merchant overtime charges which is collected under GST by the government will be exempted. It is covered under the specific exemptions. Then what are the compliances to be followed by importer? Imported goods unloaded shall remain in the custody of custodian, who shall be responsible for imported goods. If such goods are pilfered, custodian shall pay customs duty, and a bill of entry will be filed electronically through ICE gate. And we have three types of bill of entry. One is bill of entry for home consumption. For the imported goods immediately cleared for home consumption upon payment of customs duty, whereas bill of entry for warehousing or inbound bill of entry in order to deposit the goods in the warehouse without payment of customs duty under bond, and ex-bond bill of entry for home consumption when the goods are cleared from the warehouse upon payment of duty. And the time limit for filing bill of entry will be before the date of arrival, whereas we can file it even 2 days, 3 days, 4 days before also, but not before 30 days. So within 30 days prior to the date of arrival only the bill of entry should be filed, which means the validity of a bill of entry file will be 30 days. After 30 days, if the vessel or vehicle or aircraft does not arrive, so in that case a new bill of entry is required. So time limit either for home consumption or for warehousing, the time limit for bill of entry is same. Minimum before the date of arrival, maximum 30 days prior to the date of arrival, and late fee for delay in filing bill of entry. This already we have seen. If the delay is up to 3 days, 5,000 rupees per day. If the delay is beyond 3 days, 10,000 rupees per day, subject to maximum 50,000 rupees in case of exempted goods. In case of dutiable goods, subject to maximum 100% of customs duty, and they need to pay the customs duty after filing bill of entry for home consumption. And usually what is the time limit within which the bill of entry should be filed? If they are not going for deferred payment option, immediate payment option, on the date of filing bill of entry, when it is acknowledged on the same date, the payment should be done, and customs officer shall pass out of customs charge order. And after depositing the good, after unloading the goods, the goods should be cleared within 30 days from the date of unloading. Otherwise, either the proper officer will dispose of the goods or may keep it in the warehouse for a further period of 30 days. And like every 30 days, they need to do a review whether to dispose it of or to deposit the goods for a period of 30 days. If goods are not cleared for home consumption or warehousing within 30 days after unloading, such goods may be disposed of by the custodian, or officer may deposit such goods in the warehouse. For how many days it will be kept? For a period of 30 days. First 30 days is the regular time limit. Thereafter 30 days they can deposit the goods in the warehouse, and beyond 30 days for a further period of 30 days commissioner should approve. So this concept is known as warehousing without warehousing. The warehousing provisions are not applicable in this case, because here the warehousing is not done by the importer, but the warehousing is done by the customs officer. And there is a mandatory electronic payment. Importers under AEO, authorized economic operator program, like that one, it is there under AEO, or importer paying customs duty greater than or equals to 10,000 rupees per bill of entry. So they cannot make over the counter payment, they have to make only online payment. So but if the bill of entry customs duty is less than 10,000 rupees, definitely they can do the over the counter cash payment also, that is permitted. Then export procedures, this is to be followed by the exporter. First, exporter will hand over the shipping bill or bill of export to the customs officer. Shipping bill in case of vessel and aircraft, bill of export in case of vehicle, then along with that invoice and supporting documents should be submitted. If the goods are dutiable, they need to pay the duty, and the customs officer will verify the shipping bill and bill of export and will pass let export order, which means the goods can be exported. After let export order, the goods have to be handed over to the person in charge along with shipping bill or bill of export. Now the person in charge should have obtained grant of entry outwards, but grant of entry outwards only in case of vessel, and then the person in charge will do the loading of the goods into the ship. In case of baggage, it can be loaded without the permission, and this step is not applicable in case of aircraft or vehicle, and thereafter they will be filing export manifest, and in case of vehicle it will be export report. In case of aircraft it will be departure manifest, export manifest, departure manifest or export report that needs to be filed. And what is the complaints to be followed by person in charge? There unloading only at approved place, here loading only at approved place, loading only under the supervision of proper officer, and loading with the help of small boats. So shipping bill is sufficient, so boat note is not required. Only for bringing the goods from the ship to the shore, boat note is required, but for taking the goods from the shore to the ship, so boat note is not required, just the shipping bill will be sufficient. And loading on holidays or after office hours, extra charges is payable. What is that charges? Merchant overtime charges. And shall obtain entry outwards from customs officer before loading of goods, shall file export manifest, departure manifest, export report before departure, and shall file passenger name record information before departure, and shall obtain permission to leave from customs officer. So these are the things to be followed by person in charge. Usually it will not be tested, but it is there in the study material, so we are discussing this. And complaints by exporter, so they need to file shipping bill in case of vessel or aircraft, or bill of export in case of vehicle by electronic mode only, and they will assess the customs duty and pay the duty accordingly, or resort to provisional assessment. If they are able to compute, they will compute and pay, otherwise they will go for provisional assessment. They shall pay the customs duty if applicable immediately on filing shipping bill. If we don't have deferred payment facility for exporter, but for importer we have deferred payment facility, which we will be discussing in some time, and they shall be obtaining let export order. These are the compliances by exporter, and this they have asked one or two times, distinguish between transit and transshipment. So in theory question, so what is transit? If the same conveyance, whether aircraft or vessel, if the same conveyance is bringing the goods to a port in India or airport in India, from there to another port or airport in India, it is transporting the goods, then it is called as goods in transit. What is the speciality of goods in transit? Whatever is the freight, the transit freight and insurance from one port to another port in India or airport to another airport in India will be included in the value. For example, 10,000 containers were imported into Gujarat port, Surat port, and in the 10,000 containers, 6,000 containers were unloaded, and thereafter 4,000 containers to be unloaded in Chennai port. So the same ship is bringing the goods from Surat to Chennai. For that they will incur some extra transportation, freight and insurance that will be included in the freight and insurance for computing the CIF in case of goods which are unloaded in Chennai to be cleared. So therefore transit, freight and insurance will be included. Same way if it is transshipment, the same conveyance will not be bringing it from Surat port to Chennai port. Some other ship or some other aircraft will be bringing. In case of transshipment, for the transshipment some extra freight and insurance will be there, that will not be included in the value. So transit, conveyance, transit means continuing transport of goods in same conveyance, but transshipment means continuing transport of goods in any other conveyance. Bill or declaration, there is no bill or declaration is required to be filed for transit, but in case of transshipment, a bill of transshipment or declaration of transshipment is required. Continuity in records and control. In case of transit, the records will be continuing because it is the same bottom cargo that will be there, and there won't be any new records which are required. So the record already made in the ships or aircraft manifest continues. The imported goods are shown in the manifest as the same bottom cargo, thus there is continuity in the records and there is no chance of the control over such transit being lost. Whereas in case of transshipment, continuity in records is not maintained because it will now move to the another conveyance, and in the first port or airport, let it be goods under transit or transshipment, so they need to submit the details. So import manifest or arrival manifest contains the details of normal cargo as well as transit cargo, whereas here import manifest or arrival manifest contain the details of normal cargo as well as transshipped cargo, and in the subsequent port again they need to file the import manifest or arrival manifest for that cargo which they are going to transit or transship. So they have to submit 2 times. This is common in both the cases. Inclusion in the value of imported goods. Transit shall be part of CAF and freight shall not be part of freight in CAF. Then in case of import or export by post, what is the relevant date for determination of rate of duty? Goods can be imported or exported by post. In case of import by post, if it is vessel, date on which the post officer, postal authority hand over the list of postal articles to the customs officer, that date will be taken, or arrival of the vessel, whichever is later. Generally in case of import by vessel, date of presentation of bill of entry or grant of entry inwards, whichever is later, but we don't have the date of presentation of bill of entry here. So there will be one postal list or parcel list that will be created. Who will be creating it? The postal authority will create it and they will hand it over to the proper officer. So that will be taken, date on which postal authority present the parcel list to the proper officer, or the date of arrival. Instead of grant of entry inwards, it is the date of arrival of the vessel, whichever is later. Whereas in case of imports by aircraft or vehicle, then only one date, the date on which postal authority present the parcel list to the proper officer. In case of postal export, so let it be export in vessel, aircraft or vehicle, date on which exporter delivers good to the postal authority will be taken. Goods imported or exported through courier are treated on par with goods imported or exported by post. So only thing, instead of postal authority, we will change it with authorized courier or courier agency. Then next, faceless assessment, like that we have one short note question. So faceless assessment basically is that whenever we file the bill of entry, that bill of entry may be assigned to any officer who is located anywhere. He may not be our jurisdictional customs officer. So therefore it is separation of the officer for doing assessment from the physical location where the goods are being imported. Bill of entry that is identified for scrutiny is assigned to an assessing officer who is physically located in a customs station, which is not the port of import in the customs automated system. Basically what it do is that it will separate the assessment process from the physical location of the port of import using a technology platform that is called as RMS, risk management system. And from importer perspective, there is no change. Normally they will file the bill of entry. So then whenever the importer files a bill of entry, that bill of entry will be going to risk management system. The risk management system allows this bill of entry to any customs officer who is across the country, and that customs officer who is available, so will assess the bill of entry and will upload customs compliance verification in the portal. So either it may be everything is correct or there may be defects. If there is any defects, so again importer need to file a fresh bill of entry. If everything is perfect, then they will be generating out of customs charge order. That is with respect to this faceless assessment. Basically, in order to separate the physical port of import or airport of import to the officer's location. So they will be doing this. And powers of customs officer, as per section 37, customs officer at any time can board any conveyance carrying imported goods or exported goods and may remain in such conveyance for such period as he considers necessary. Same way section 38, customs officer may require person in charge of any conveyance to produce a document and answer any questions in relation to import or export. Then next one, what we have is payment of customs duty through electronic cash ledger and electronic credit ledger. Like how cash ledger and credit ledger concept we have in GST, the same way it is there in customs also. In case of electronic cash ledger, any amount that is deposited in the ledger will be credited to this ledger and it will be used for payment of tax, any duty, interest, penalty, fee and others. So DIPFO, there it is TIPFO, here it is DIPFO, duty, interest, penalty, fee or others. So for that we can use an unutilized balance we can claim as a refund. Whereas electronic duty credit ledger, any incentive that is payable under customs or FTP, that incentive will be credited to this ledger and we will be generating a e-script based on that. For every incentive, one e-script will be generated and that e-script will contain some incentive amount that will be used for the payment of basic customs duty on import, but we cannot use it for any other purpose. And if you don't want to use it, you can transfer the e-script to any other person, and that is this refund payable upon export or incentives under FTP are credited to this ledger. Balance in this ledger can be used only for payment of customs duties. That too, which customs duty? Only basic customs duty. unutilized balance cannot be claimed as refund, but we can transfer the duty credit scrip. So in this regard, we have some regulations, electronic cash ledger regulations. Whatever deposit that is made in the electronic cash ledger shall not accrue any interest. And how we will make the deposit? We will make the deposit through a challan that will be valid for a period of 15 days. You don't have to remember what is a challan form, etc. And what are the various modes of deposit? Either we can deposit through net banking, NEFT, RTGS, over the counter cash deposit up to 10,000 rupees, and OTC limit of 10,000 rupees per day shall not be applicable to government department or upon authorization of customs officer if the deposit is made. And here this 10,000 rupees should be understood as 10,000 rupees per bill of entry. Then commission or charges payable for deposit shall be borne by the person making the deposit. Upon successful payment, one challan identification number shall be generated, and whatever amount that is there in the ledger can be used for payment of duty, interest, penalty, fee or any other amount payable under the Customs Act or Customs Tariff Act, and whatever balance that can be either claimed as refund and which shall be paid into the bank account of the importer or exporter. And this section 51 is not applicable in some cases, that is wherever customs automated system is not in place, that is IC gate system is not in place. So there this cash ledger regulations are not applicable. For accompanied baggage of the passenger also cash ledger not applicable. And for making payment other than under Customs Act or Customs Tariff Act, that is warehousing charges or custodian charges or demurrage charges, ship demurrage charges, for all those payments, so we don't have to use the cash ledger. The cash ledger regulations are not applicable. Making payment other than duties under customs, IGST, compensations, interest, penalty, fee or any other amount, that is custodian charges, demurrage charges, etc. So this is about electronic cash ledger regulations. Again, for theory it is useful. They will ask, write a short note on electronic cash ledger and what are the cases where electronic cash ledger is not required to be followed like that. So you need to write these points. Then electronic duty credit ledger regulations. So what will happen? First we will file a shipping bill or bill of export, and that shipping bill or bill of export, there will be some incentive which we need to get as per that bill of entry, bill of export or shipping bill, having a claim of duty credit that can be under any scheme. It can be duty drawback or it can be RODTEP scheme or any other scheme that may come in future. So shall be processed in the customs automated system, and the claim shall be allowed by the customs as per the conditions and restrictions. After filing the export manifesto or export report, once a claim is allowed, one script will be generated, e-script, electronic script for duty credit, which will be generated by the proper officer in the automated system, and separate scripts will be generated for each scheme. And the duty credit available in the e-script shall be used for payment of duties of customs, that is basic customs duty, and the e-script will be valid for a period of 2 years from the date of its generation, which means within 2 years the e-script should be utilized or it should be transferred to some other person. The duty credit in the e-script that has been lapsed, say 2 years over, the e-script is lapsed, it shall not be regenerated, and all the ledger including e-script and the transaction shall be visible in the IC gate, that is customs automated system. Transfer of duty credit in e-script shall be allowed within the customs automated system. So from one IEC holder to another IEC holder, so we can transfer the duty credit, and the number issued in terms of FTP. So the duty credit available in an e-script shall be transferred at a time for the entire script. So in part it cannot be transferred. For example, in e-script there is 2 lakh rupees, 1 lakh cannot be transferred, or 50,000 cannot be transferred. Entire 2 lakhs only can be transferred. So at a time for the entire amount in the said e-script to another person, and transfer of duty credit in part shall not be permitted. So this again you get a theory question. Write a brief note on electronic duty credit ledger. So these points, any 4 or 5 points if you write, that is sufficient. Then the important area, so this is usually neglected by students, but definitely they can make question on this. Import of goods at concessional rate of duty rules for specified end use rules 2022. First we need to understand the background of these rules. There is a manufacturer or a service provider who is eligible for an exemption notification. First there is a exemption notification. As per that exemption notification, you can import the goods without payment of customs duty, or you can import the goods at concessional rate of duty, and you are a manufacturer or a service provider or even a trader who is making sale to the specified end use recipient. You are a manufacturer of notified goods, you are a service provider providing the notified services, or you are a trader providing sale of goods, like you are selling the goods to the specified end use recipient. for import of goods. So what does that exemption notification says? You can import the goods without payment of customs duty, or you can import at the concessional rate, and you need to use that imported goods in the manufacture of any commodity or provision of any output service, including after sale service, or being put to specified end use, which means you can sell it to the specified end use recipient. So three positions: either manufacturer of notified goods, or a service provider of notified services, or a trader who is making sale to the specified end use recipient. You are eligible for exemption notification, which allows you to import goods without payment of customs duty or at concessional rate, and for you these rules are applicable, and either you can do the manufacture or you can get it done on job work basis. There is no such condition that only you should manufacture. You can get it done on job work basis. However, job work in case of gem and jewelry sector is not allowed. However, some sectors such as gold, jewelry, precious stones and metals have been excluded from job work basis. And even services, any notified service but other than after sale service is also not allowed. So this is the applicability of the rules, when these rules are applicable. And what is the procedure to be followed? There is an importer who is located in Coimbatore, Tamil Nadu, and he is eligible for exemption notification to import the goods without payment of duty or at concessional rate. First he need to make a request to the ICE gate, wherein he need to mention under which notification he is eligible for import without payment of duty or concessional rate, what goods he is importing, which port he is importing. So all those details he need to mention. That is information in form IGCR 1. And then when they are submitting that document, so along with continuity bond with surety and security, so immediately the customs common portal will verify that form and will be generating IIN, import of goods at concessional rate of duty identification number. One number will be given. That number they need to quote at the port of import or airport of import while filing bill of entry. So say they are importing to Chennai port, in that they will file a bill of entry. In that bill of entry this IIN needs to be quoted, so that the customs officer in the Chennai port or airport will understand that they are not required to pay duty or they are required to pay concessional duty, and accordingly process that bill of entry, and those goods needs to be brought to Coimbatore. And suppose if there is any short receipt of goods, that is he made application for 1000 units but what is imported is only 800 units, there is a short receipt of 200 units, that needs to be intimated to the portal. Intimation in ICGR 2 regarding non-receipt or short receipt of goods, and then thereafter any unutilized goods or defective goods out of that imported goods should be either exported back or should be sold in India upon payment of duty with interest within, previously it was 6 months, now it is within 1 year, plus it can be extended for a further period of 3 months from the date of import. This is the time limit within which the unutilized goods or defective goods out of imported goods should be either exported or sold in India. If it is exported, what is the condition? So the value of that exported goods should be greater than the value of the said goods at the time of import. And suppose if it is sold in India on payment of duty along with interest, and what is the rate of interest? 15% per annum. Why we need to pay duty? Initially at the time of import we did not pay duty or we paid concessional duty. So now those goods are not consumed by us because these are unutilized goods which are sold. So therefore they need to pay customs duty now or the differential duty which they got benefit at that time. Along with interest they need to pay. And see the FAQs in this regard. What is the information that needs to be submitted? Name and address of the importer and his job worker if any, and what are the goods that are to be imported or the process that is to be undertaken, and nature of output service, and under which exemption notification you are eligible, and the port where you wanted to import, and particulars of the premises intended to be used in case of unit transfer, and details of end use recipient. This is the basic information that needs to be submitted. And what is the procedure for sending the goods for job work? Any imported goods by the manufacturer, either they can do the manufacture or they can get it done on job work basis. So if they are sending it on job work, that should be under the cover of a delivery challan plus e-way bill, and they have to receive the goods back within 1 year. So previously it was 6 months, now they have modified it to 1 year to keep it in line with GST. GST also, any goods which are sent to the job work should be received back within 1 year. So therefore they modified this time limit to 1 year, and they have to mention all these details of goods sent on job work and received from job work in a quarterly statement. That quarterly statement, previously it was monthly statement, now they have modified it to quarterly statement. And job worker shall maintain necessary records with respect to such goods. Can the imported goods be transferred from one unit to another unit? Yes, unit to unit transfer can be done. Unit to unit means it will become distinct person. So therefore that should be under the cover of an invoice and e-way bill. And maintain accounts and records regarding goods sent, received, waste generated if any during manufacturing process. And all these details should be mentioned in the quarterly statement. What is the procedure for supplying imported goods to specified end-use recipient? Same way, those imported goods can be sold to specified end-use recipient. For example, to defense, they can make the sale, and if they are making sale, they have to mention the details in the quarterly statement. Plus, this good should be under the cover of an invoice plus e-way bill. In case of supply for replenishment or export against supply, the end-use recipient also should maintain the necessary records as to which date, how much quantity, because frequently we will be making sale to end-use recipient. The end-use recipient also should maintain a register related to when, which goods, what goods they have purchased, etc. Then can the capital goods be imported under these rules? Yes, capital goods can also be imported under these rules, and we don't have any time limit to export it back or sell in India. There is no time limit. That 1 year plus 3 months whatever we discussed, that is only for other than capital goods. For capital goods we can use it, but only thing, if the capital goods are sold without using it for the purpose for which it is imported, then we need to pay the customs duty on at the depreciable value. Capital goods which are capitalized in the books of the importer can be imported at concessional rate for use in manufacture of notified goods or for providing notified services. After that, say after the manufacture got completed, after the notified services also over, then the goods can be cleared in domestic market on payment of duty and interest at what value? Depreciable value. We need to take the depreciable value on which we need to pay the customs duty. What is the type of bond to be executed? So there is a continuity bond with such surety or security as deemed appropriate by the jurisdictional ACDC of customs, with an undertaking to pay an amount equal to difference between the duty leviable on inputs but for the exemption and that already been paid, if any, with the applicable interest. So one bond needs to be executed. That bond is a continuity bond. Every time you are importing, to whatever extent you saved the duty, to that extent the bond gets debited. Again, when you submit the quarterly statement, you will mention as to what goods you have manufactured and services you have rendered and the sale to the specified end-use recipient. Once you meet the purpose, the bond will be credited back. So like that, it is like a continuity bond. Suppose if the imported goods are not used for the purpose for which it is imported, you undertake to pay the customs duty along with interest. If you fail to do so, using that bond, they will recover that money. What is the rate of interest and period for which interest is computed? Interest at the rate of 15% per annum from the date of import of goods. Import of goods means the date of out of customs charge order, and till the date of payment of duty we need to pay the interest. And what are the accounts and records to be maintained by importer? So whatever goods that is imported, date on which it is imported and in which premises, and quantity of goods consumed, how much is sent for job work received from job work, goods re-exported if any, and the goods which is remaining in stock. And all these accounts and records should be made available to the ACDC of customs as and when demanded. That is an amendment. How to compute the depreciable value of the capital goods and customs duty on the capital goods? For computing the depreciable value, first we need to state for every quarter or part thereof in the first year, we need to reduce 4%. For every quarter or part thereof in the second year and third year, it will be 3%. For every quarter or part thereof in the fourth year and fifth year, it will be 2.5%. And thereafter it will be 2%. Remember, 4, 3, 2.5, 2. 4, 3, 2.5, 2. 4 will be for first year, and 3 will be for second and third year, and 2.5 will be for fourth and fifth year, and thereafter from sixth year onwards it will be 2%. So this we need to take as the depreciable value, and this is the percentages which you need to reduce from the value of the imported goods, and on the depreciable value we need to pay. And how to calculate this? Is it like a straight line method? Yes. The quarter or part thereof should be like a straight line. Calendar quarter should be taken. It's not like, say for example, 15th March to 15th June. So you should not take it as one quarter, you should take it as 2 quarters, because it comes in the March also and it comes in June ending quarter also. You need to count it as 2 quarters. Quarter is period comprising of 3 months ending March, June, September and December. And customs duty on above shall be equal to difference between the duty leviable on such goods but for the exemption. So whatever is the depreciable value of the goods, on the depreciable value of the goods you need to see how much is the actual customs duty payable minus at the time of import you would have already paid some concessional duty that needs to be reduced. So the differential duty is what we need to pay. And when the unutilized or defective goods should be exported or sold in India within 1 year plus 3 months from the date of import, and it is not applicable in case of capital goods. What are the other compliances? A quarterly statement to be filed within 10th of the month following every quarter. So what is the time limit by which quarterly statement needs to be filed? 10th of the month following every quarter. Then looking to the next area, that is assessment and audit under customs. So we have self-assessment. Section 17 of Customs Act deals with self-assessment. That is, as soon as the bill of entry is filed by the importer or shipping bill is filed by the exporter, which will contain the duty liability, that is known as self-assessment. They need to compute how much duty they need to pay, and whenever they are filing bill of entry or shipping bill, so that bill of entry or shipping bill will be taken up for verification by the proper officer. If everything is found in order, then the bill of entry or shipping bill will be approved. If there is any discrepancy, the proper officer will do the reassessment, and that reassessment when they do, you have two options, either to admit that reassessment amount and pay the duty, or ask the officer to pass a speaking order. So against that speaking order you can go for appeal. What is the time limit within which the order should be passed? Within 15 days from the date of reassessment of bill of entry. So first duty to be self-assessed by importer or exporter, verification by proper officer, reassessment of duty, importer may agree to pay the same by amending bill of entry or shipping bill, and speaking order for reassessment. The speaking order will be within 15 days from the date of reassessment. If you get a theory question on self-assessment, you need to write this 5 points. Then provisional assessment. Provisional assessment, section 18 of Customs Act. I don't think so provisional assessment they will be testing for this attempt, because in this attempt, like next attempt onwards, completely there is a revamp in provisional assessment. Literally some 3-4 pages of information is there in provisional assessment itself. So lot of changes they have made. So theoretical part they may not ask, only interest computation in provisional assessment will be tested. So say this, what are the situations that leads to provisional assessment? Importer or exporter is unable to do the self-assessment, or proper officer deems it necessary to carry out the chemical examination or test. You are an importer or exporter and you could not compute how much is the value or how much is the rate, so you could not compute the customs duty, so you will go for provisional assessment. Or the proper officer wanted to carry out the chemical examination or test in order to determine the true value of that goods or true identity of that goods, so then also they will go for provisional assessment. Proper officer is asking you for certain documents and you did not submit those documents, then also they go for provisional assessment. Proper officer asks for certain documents, you submitted those documents, but still the proper officer deems it necessary to carry out further inquiry, then also they will go for provisional assessment. These are the 4 situations that leads to provisional assessment. And whenever the importer is going for provisional assessment, they need to execute a bond. What is that bond for? 2 times the duty payable. So in case of warehousing, it will be 3 times the duty payable, which means total 5 times the duty payable you need to go. If it is provisional assessment of warehoused goods, yes, you are right. Provisional assessment of warehoused goods. Generally for warehoused goods 3 times. For provisional assessment 2 times. You are going for provisional assessment of warehoused goods. Then in that case, this bond also to be executed. That bond also to be executed. Importer executes a bond along with security in the form of bank guarantee at the time of provisional assessment, which shall be released upon payment of differential amount after final assessment. However, in case of warehousing, bond executed, that is 2 times the differential duty after finalization of assessment, shall be released after payment of differential amount. Also, for deposit of goods in the warehouse, a bond is executed 3 times the duty payable and shall be released upon clearance from warehouse. So we have to execute 2 separate bonds. Then next, customs finalization of provisional assessment regulation. First there will be an order for provisional assessment, and when they pass the order for provisional assessment, they will intimate to you to furnish the documents within 15 days. So you should submit the document within 15 days. However, it can be extended for a further period of 3 months by customs officer, or further period of 3 months by ACDC plus unlimited time by the commissioner. And then there will be finalization of provisional assessment. What is the time limit within which finalization will happen? Whether you are submitting the documents or not submitting the documents. Suppose you are submitting the documents, then whenever you submitted the documents, from there within 2 months, they need to complete the assessment, final assessment. If you have not submitted the documents, there is a time limit to submit the documents. From there within 2 months, they need to finalize the assessment, and there is an extension of time limit. So this 2 months will be extended for a further period of 3 months by commissioner. And this is what I told you, that it is not important for this exam. This procedure is not important. However, they may ask a question related to this, that is, whenever the final assessment is more than provisional assessment, are you required to pay the interest? Yes. At what rate you need to pay interest? 18% per annum. From which date to which date? From the first date of the month in which provisional assessment is resorted till the date of payment of the differential duty. For example, provisional assessment is made on 28th March. You need to count interest from 1st of March. So that is goods cleared for home consumption or exportation, differential duty payable. Goods cleared for warehousing, bond executed for 2 times the differential duty. Interest payable at the rate of 15% from the first day of the month in which duty is provisional assessed till the actual date of payment of difference. So first day of the month in which duty is provisionally assessed, and not the next month. First day of the month in which duty is provisionally assessed. When final assessment equal to provisional assessment, you don't have to pay anything, you will not get anything. Suppose if the final assessment is less than the provisional assessment, already you paid some excess amount, that you will get it as a refund, and that refund you will get within 3 months from the final assessment. There is no application and all in this case. Within 3 months from final assessment, you will get the refund. If you are not getting refund within 3 months from final assessment, then interest will be given to you at the rate of 6% per annum for every day delay after 3 months. And refund of differential duty upon final assessment is subject to unjust enrichment. You need to prove that you have not transferred the burden to any other person. So that is there. If the burden is already transferred, then the amount to be refunded is transferred to a consumer welfare fund. And provisional assessment is applicable for both import and export. And any violation of this provision, what is a belated penalty? I mean, like penalty up to 50,000 rupees. Then audit under customs, section 99A, that is post clearance audit. Any imported goods or exported goods can be audited after clearance and payment of customs duty. So either that audit can be done at the site, I mean like in the premises of the customs officer, or it can be done in the premises of the auditee. Post clearance audit, structured examination, post clearance of goods from customs, of business relevant commercial systems, sale contracts, financial and non-financial records, physical stock and other assets. So not only import and export, even the financial statement they will verify, and they will verify the commercial systems, non-financial records, stock they will verify, and all assets also they will verify to measure and improve compliance. And where the audit should be conducted, may carry out the audit of assessment of imported goods or exported goods or of an auditee under this act, either in his office or in the premise of the auditee, in such manner as may be prescribed. Who is the auditee? Not only importer or exporter, every person who is connected with the import and export. It will include custodian, it will include this consolidation agent, that freight forwarding agent, customs broker or warehouse keeper. Everyone who is connected with the import and export is the auditee. And customs audit regulations, records to be preserved by the auditee for a minimum period of 5 years. It should be preserved for a period of 5 years, and in case of GST it will be 6 years from the due date of filing annual return, but here it will be 5 years from the end of the financial year, and it may be either in manual or electronic, and make available the records to the proper officer as and when demanded. And selection of auditee or documents based on risk parameter, not that everyone will be selected for audit, so based on risk parameter. And audit can be conducted at the auditee premises, a 15 days notice to be given, whereas in case of GST 15 working days notice, but here it is 15 days notice. CRCMA can be appointed for assisting the audit on prior approval of commissioner. Not that this audit will be done by CRCMA. CRCMA can assist in conducting the audit. Contravention of any provision, penalty up to 50,000 rupees. There are two types of audit: transaction based audit and premises based audit. In transaction based audit, so few transactions like sampling technique they will be taking it and they will be verifying, and suppose if there is any discrepancy in that, then they will convert it into premises based audit. Then interest on account of delay in payment of customs duty. For payment of customs duty, we have two options on import. One is immediate payment option, second is deferred payment option. deferred payment option is not applicable to everyone. Deferred payment only to authorized economic operator or certain export house like 2-star, 3-star, 4-star export houses. They only can get deferred payment of customs duty option. And if it is immediate payment option, today you are filing bill of entry. Today itself you have to pay the customs duty, that is the day on which bill of entry is processed. Acknowledge that date itself the duty has to be paid. If there is any delay, there will be interest at the rate of 15% per annum for every day delay. So immediate payment or the date of presentation of bill of entry, interest at the rate of 15% per annum for every day delay. Whereas in deferred payment option, if the bill is returned between 1st to 15th of a month, then 16th working day of that month, so means excluding the holidays, between 1st to 15th, you need to see how many Sundays are there or any public holidays are there, and you need to just extend it so that we will get the 16th working day. Suppose if the bill is returned between 16th to end of that month, so next month first working day, which means here you need to see how many Sundays or holidays are there, you need to just add it. So next month you will get the first working day, and suppose if it is a month of March, it is 31st March only will be taken. So that is this 3 points, and by the due date, if you are not making the payment, interest will be payable at the rate of 15% per annum for every day delay beyond the due date. And to whom this will be applicable? Class of importers who can avail this facility will be notified. So likely customs covered under authorized economic operator scheme. Eligible importers intending to avail this facility shall intimate to the jurisdictional commissioner, and duty to be paid by the due dates through electronic mode. If there is a default in payment by due date more than once in 3 consecutive months, which means in 3 consecutive months there will be 6 due dates. Okay, in 3 consecutive months there will be 6 due dates, and if any one particular due date is missed, this will not be disallowed. So 2 times, correct? More than once. More than once means what? Greater than 1 is 2. So 2 times or more than 2 times. If there is a default in payment by due date more than once, that is more than once means 2 times or more than that, in 3 consecutive months, this facility will not be unloaded unless the duty with interest is paid in full. Also, this facility is not available for goods not declared in the bill of entry. Then duty payable on account of reassessment or provisional assessment. Reassessment or provisional assessment means whenever we are filing the bill of entry, that may be rejected, and they will do the reassessment. So that reassessed duty or under the provisional assessment some amount we need to pay, that one we need to pay within 1 working day. It is within 1 working day, 1 working day, that is excluding holidays from the date on which the bill of entry is returned to him by the customs officer. Generally it is the same day on which bill of entry is filed, immediate payment. But in this case of reassessment or provisional assessment, they have given 1 working day, and interest will be at the rate of 15% per annum for every day delay beyond the due date. Whereas in case of final assessment of provisional assessment, the differential amount we need to pay, and there the interest will be 15% per annum from the first day of the month in which provisional assessment is resorted till the date of payment of that differential duty. So this is about the interest calculation. So mostly in provisional assessment, if at all they are asking question, it will be on interest computation. Then baggage provisions we discussed, and look into stores under customs. The stores under customs is a neglected area. They have not asked one question also so far in this, page number 274. So just this much information only we have. So stores refers to what? Goods which are present in the vessel or aircraft. So that is whether or not for immediate consumption, like spare parts, fuel, other articles which are not for immediate fitting. And next definition you need to know, foreign going vessel or aircraft. So which is a vessel or aircraft which is going from India to a place outside India. So any vessel or aircraft for the time being engaged in the carriage of goods or passengers between any port or airport in India and outside India, irrespective of touching any intermediate port or airport in India, and it includes any naval vessel of a foreign government taking part in any navy exercises. So and any vessel engaged in fishing or other operations, and even any aircraft or vessel proceeding to a place outside India. So not necessarily carrying goods or people, maybe for participating in war, etc. That will also come under foreign going vessel or aircraft. And what is the treatment? Suppose if there is a person who is importing goods, okay, who is importing any goods, say some beverages, alcoholic beverages, etc. they are importing, and that particular beverages which are imported, or this fuel aviation turbine fuel that is imported, this can be kept in the warehouse. There are two options. There are two options. If the importer is making sale to a foreign going vessel or aircraft, there are two options. Option 1, those imported goods can be kept in a special warehouse and cleared as stores without payment of customs duty. Why? Because sale to foreign going vessel or aircraft is treated as export under Customs Act. It is treated as export under Customs Act. Sale to this vessel or aircraft, okay, sale to this vessel or aircraft treated as export. Sorry, it is given as not treated pa. Sale to this vessel or aircraft is treated as export under Customs Act, and due to that reason, whenever we are importing the goods and we are making sale to this foreign going vessel or aircraft, we can clear it without payment of customs duty. Or option 2, we can pay customs duty and then we can sell it to foreign going vessel or aircraft and claim the duty drawback. How much is the duty drawback? Duty drawback means what? Refund. So how much refund? Whatever we paid customs duty on import, if it is fuel, 100% refund. If it is other goods, we will get 98% refund. Please try to understand. You are an importer. You are importing the goods. Upon payment of customs duty or without duty, you can import. So like first option, you are importing the goods. You have deposited the goods in the warehouse without payment of duty. Thereafter, you sold it to the foreign going vessel or aircraft. Still no need to pay duty because sale to foreign going vessel or aircraft is treated as export under customs. Imported goods kept in warehouse and exported from there. You don't have to pay any customs duty on these goods. Or option 2, you can import the goods, clear it for home consumption, pay the duty, and when you are making sale to foreign going vessel or aircraft, out of the customs duty paid on import, you will get the refund. How much refund you will be getting? If it is fuel, 100%, if it is other goods, 98% you will get. And even though it is export under Customs Act, but under GST it is not treated as export. So therefore for GST it is like a regular sale. When you make sale to the foreign going vessel or aircraft, this is like a regular sale that will be chargeable to GST. Then what if you are importing the goods and making sale to a domestic vessel or aircraft? In that case, so it is not treated as export under customs. So the regular provisions will be applicable, which means either you can import the goods and you can keep it in the warehouse, and later on you can clear from warehouse on payment of duty and sell to vessel or aircraft for domestic transportation, or directly also you can import it, pay customs duty and sell it to the vessel or aircraft for domestic transportation, and this vessel or aircraft not treated, sale to this vessel or aircraft not treated as export under customs. Then second case, you are importing goods as stores. So you are importing of stores, that is fuel left over in the tank. So you are importing an aircraft, the aircraft is coming, in that aircraft some fuel is left over. So that particular fuel is sold by the shipping company or aircraft operator. No, they are not selling it to anyone, but that will be import. Why that will be import? Because even the goods can be imported as stores. The fuel left over in the tank which is brought to India will also be treated as goods imported, and on that customs duty will be payable if that particular aircraft or vessel is used for domestic transportation. If it is used for foreign going vessel or aircraft only, no need to pay customs duty on that fuel. So if it is in a foreign going vessel or aircraft and retained in it, customs duty not payable on such imported stores. If it is in a foreign going vessel or aircraft and used for domestic transportation, customs duty payable on such imported stores. Then next one, there is a manufacturer. That particular manufacturer is importing raw material. On import of raw material, he paid the customs duty, and that manufacturer is making sale to a foreign going vessel or aircraft, and this is supply of goods as stores. Whether GST is payable or not, yes, GST is payable on sale and it is treated as export under Customs Act. Now listen carefully. So whenever he is making sale of finished goods, now to what extent it will be allowed, to that extent only it is no need to pay duty. Remaining case we need to pay. So if the goods are dutiable, up to the permitted quantity customs duty not payable, on balance quantity customs duty payable, and suppose if it is non-dutiable goods, then no doubt customs duty not payable on this, because it is treated as export under Customs Act. What if the manufacturer is making sale to a vessel or aircraft for domestic transportation? Then normally it will become supply and chargeable to GST, not treated as export under Customs Act. And this manufacturer will be making sale, so he need to pay GST on import. Whatever ITC like IGST paid, that can be taken as ITC. And wherever we discuss foreign going vessel or aircraft, that includes Indian Navy vessel also. Then warehousing we have completed, and look into refund under customs. Refund under customs, we have 3 sections where the refund is available. Section 26, Section 26A and Section 27. 26 is applicable in case of export. First of all, you are exporting the goods. Upon export, you paid the customs duty, and those customs duty paid on export will be refunded to you if the exported goods are returned. Okay, goods exported on payment of duty and imported otherwise than as resale, that is returns or rejections. And what is the time limit for application? 6 months from the date of order of home consumption. So you need to make the application. I mean, first you exported, those exported goods got returned. So whenever it got returned, whenever it got imported, from the date of import, within 6 months, that is clearance for home consumption, within 6 months we need to make the application. And what is the amount of refund? 100% of customs duty paid on export, we will get it as a refund. And other points, goods should be imported within 1 year from the date of export. From the date of export to import, what should be the time limit? 1 year. And customs duty not payable, because at the time of export you are only paying the duty and the same goods got returned. At the time of export you did not claim any incentive. At the time of export you did not export it for repairs, etc. So upon re-import you don't have to pay any customs duty. So therefore customs duty not payable on re-import on account of section 20 read with relevant notification that we saw in exemption. And what is the time limit for getting the refund? Once you make application for refund, within 3 months they need to sanction the refund to you. Otherwise interest will be payable at the rate of 6% per annum. Then second, section 26A. 26A is applicable in case when the imported goods are either exported or you have relinquished the title or you have destroyed because the imported goods are not in accordance with the specifications. Imported goods either exported, destroyed, abandoned as they are not conforming to the specifications or defects. What is the time limit for application? 6 months from late export order or date of destruction or date of abandonment. And what is the amount of refund? 100% customs duty paid on import. So you will be getting. So any of these 3 things can be done. Either you can export it or you can destroy it or you can relinquish the title. Abandon means relinquish the title. But very important condition is that these goods should not be conforming to the specifications or defectives. If it is good goods, so then definitely this section is not applicable and you will get 100% of customs duty on import. But there are certain conditions. The goods should have been exported or destroyed or abandoned within 3 months. That's what I told you. So after import, within 3 months or 30 days plus 3 months, you should have relinquished the title under 26A, that logic. So therefore within 30 days plus 3 months from the date of import, you need to either export it, destroy it or relinquish the title, and these goods should not be used. If it is used, definitely you cannot claim that it is defective goods, but using to check whether it is defective or not is allowed, but commercial usage is only not allowed. And you will get the duty drawback under 74 should not be claimed. There is a duty drawback concept. That duty drawback under 74 should not be claimed, and refund is subject to unjust enrichment. Duty drawback chapter is not there for you, it is there for CMA final students. So for CMA final students, I have uploaded duty drawback separately in my YouTube channel, so you can see that. And refund subject to unjust enrichment means what? We need to prove that we have not transferred the burden to the next person. And here also the same 3 months. So once we make application for refund, within 3 months they need to grant, otherwise interest at the rate of 6% per annum. The last section is section 27, that is customs duty paid in excess. By mistake we have paid the customs duty. And what is the time limit for application? Within 1 year from the relevant date. What is the relevant date? Usually the date on which we paid the customs duty. And how much is the refund? Either 100% of customs duty paid on import or export, and refund amount should be equal to or more than 100 rupees. So less than 100 rupees will not get. In GST it is less than 1000 rupees we will not get refund, but in customs it will be less than 100 we will not get refund. And refund is subject to unjust enrichment, but in one case the time limit is not applicable, that is duty paid under protest. We are importing the goods and we paid the duty under protest and we won the case. Now in this case whatever refund they are giving, no time limit for application. So application within 1 year is not applicable. If duty is paid under protest, no time limit for refund application. Even in this case, once you make refund application, so within 3 months they will grant refund, otherwise interest at the rate of 6% per annum. In some cases, refund is not subject to unjust enrichment. What are the cases? First, importer or exporter has not passed on the duty or incidents to other person, then no need to prove unjust enrichment because he did not pass on the incidents to other person. Number 2, the buyer is going for refund. The buyer, the ultimate buyer who purchases the goods, who borne the incidents, is making the application for refund. So you don't have to prove unjust enrichment. And imports by individual for his personal purpose. The importer is using for his own purpose, own consumption. Then also they don't have to prove unjust enrichment. And export duty under section 26. This export duty under section 26 also no need to prove unjust enrichment. Then 5, duty drawback. And 6, duty or interest borne by notified applicant. They will be from time to time notified. Commissioner will notify some applicants. So if they are notified applicants, they don't have to prove unjust enrichment. And finally, you have paid some excess duty and that is clearly evident from the bill of entry. For example, one question they have given that circular itself. You imported 200 units, but you paid the customs duty by mistake, assuming it as 400 units. Definitely there is no possibility that the 200 units you would have sold because what you have imported is only 200 units. Clearly it is evident in the bill of entry. In that case, definitely refund will be given to you because there is no possibility of sale of 400 units when you have paid the customs duty on 400 units because you have imported only physically 200 units. So clearly it is evident in the bill of entry that the duty has been paid in excess. Duty paid in excess by the importer before order for clearance for home consumption. It is evident from the bill of entry or reassessed bill of entry. Then next what we have is foreign trade policy. So there are few queries. Sir, for refund in case of excess of safeguard duty or anti-subsidy duty, the time to calculate refund from the date of payment of provisional duty or the date of completion of investigation by the proper officer. We don't have any provisions in relation to that, how much interest they will be giving, etc. and all. That refund provision will be governed under those sections along with the regulations which is not there in syllabus. So we don't have to bother about that. Okay, that is not applicable for you and they will not ask any question also on that. Then under classifying an activity as supply of goods or service, an artist is doing fabric painting. The paint on t-shirts or garments by hand, and is it supply of goods or supply of services? If the t-shirt belongs to the recipient, it will be supply of service. If the t-shirt belongs to them, then it will be supply of goods. So lot of branding companies are there. They only buy the t-shirt, they do the embroidery on the t-shirts and they will be selling the t-shirt. It will be supply of goods. If you give the t-shirt, they do only embroidery or designing on the t-shirt, then it will be supply of service. Okay. Then can this mighty 50 be used by CMA final students? Yes, very much yes. Very much yes. Trust me, CA final, there is no change in syllabus. The same portion is there. Perhaps when you prepare it for CA final, for CMA final and all, you will get 80s and 90s. Okay. Because I never took any batch for CMA final separately, but I have got, like for us, around 38 ranks we have got in CMA final, including All India first rank, second rank. Okay. So I did not take, but only thing, the moment when they listen for CA final, when they go for exam for CMA final, it is too advanced for them. So because of which they will be getting 80s and 90s, good only na. So if you get good marks, okay. So same portion only, trust me. Then next, only people, other people are listening to my rocket revision and they are taking in their mother tongue and they are posting CMA final videos like that. So that people are watching, but the original source and all you are not watching. Too much here. Maybe I have to rename the video. I will re-upload the same video as CMA final. Then you will, believe. So, sir, suppose from Surat to Chennai, they bring the goods through vehicle, insurance expense or any other expenses incurred in between shall not be included for CIF. Yes, provided it is transshipment. If it is transit, it will be included. Only transshipment, it will not be included. Sir, if we pay any tax within 60 days from the show cause notice under 74A, but after 60 days, we paid penalty. What will be the penalty? No. You have to pay penalty, tax, everything within 60 days from show cause notice. Otherwise, 50% of the penalty because already you paid the tax. Order they will not pass, but penalty not paid within 60 days. So 50% penalty will go. If you pay within 60 days, it will be 25% of the penalty. Is it clear? Then next, sir, supplier supplying restaurant service through e-commerce operator, whether need to be included in turnover of both the parties. Yes, because whenever actually it is exempted for restaurant and it will be taxable for e-commerce operator, including both the turnover, but under which heading? For e-commerce operator it will be coming under taxable turnover because e-commerce operator will pay GST, and for restaurant it will be exempted because on that supply of food where e-commerce operator pay GST, now they will deduct the commission and they will remit the remaining amount to me. That amount which they have remitted to me will be coming under exempted supplies, okay, for the restaurant, and it is common for all 95 cases. All 95 cases, supplier will receive some money from e-commerce operator that they need to show as exempted supply, because in all 95 cases who will pay GST? E-commerce operator will pay GST. Then next, for section 26 of Customs Act, the import should be return or rejection. Yes, it is mainly because returns or rejection or both, anything. Either they are returning the goods or they are rejecting the goods. It can be for any reason. But the goods which are exported by you will be returning back to India. Even rejected goods also will be covered there. Then import of services for consideration, whether or not in the course or furtherance of business is supplied, but import of OIDR service by individual is exempt. Is this correct? Wrong, because OIDR service will always be taxable. Whomsoever is importing, it will always be taxable, but only thing, it will be like supplier under FCM will pay GST, the importer will not pay GST. Only import of other than OIDR service by individual for personal purpose will be exempted. Okay, that alone will be exempted in this case. Fine. So these are some queries. And foreign trade policy. So in foreign trade policy, previously at least they used to ask one question, wherein nowadays students are leaving it in the choice. So question number 6. But in IBS they can test foreign trade policy, and MCQ also they can make one MCQ, but that too optional only. They are not asking. So they are restricting it to one 4 marks question. That's it. And because literally MCQs on customs will be 2 MCQs, only 2 MCQs for 4 marks, or maybe 3 MCQs for 6 marks, because you need to write, this 5 questions. In these 5 questions, 4 questions only. Question number 1, you will not have customs portion. 4 questions only, part C. So 4 into 4 is 16. So in MCQ, 2 MCQs are only possible, because now they have reduced it to 20 marks. That's the reason why customs you will definitely not find any difficulty. So if you just listen once, that is sufficient. So this FTP also, even though you are going to skip, it's okay, but nothing wrong in spending some time on this. So this time what you are going to spend will not be wasted. Okay, so it may be useful somewhere. So please listen. So foreign trade policy is set of guidelines or instructions issued by the central government, either ministry like Ministry of Commerce and Industry. Why not Ministry of Finance? Because foreign trade policy is not governed by Ministry of Finance, it is governed by Ministry of Commerce and Industry, and it has a separate act, that is Foreign Trade Regulation and Development Act 1992. And basically foreign trade policy will give the instructions for regulating the foreign trade, that is regulating the imports and encouraging the exports. And FTP regulates, develops and promotes international trade. But what is the difference between FTP and customs? So FTP will take care of regulation and development of international trade, that is the mind of the international trade, what to import, what to export. But the body of the international trade, how to import, how to export, and what amount to pay as customs duty, all those things will be there in Customs Act, that contains the procedures, valuation and consequences. The provisions of FTP are governed by Foreign Trade Regulation and Development Act. The FTP is formulated, supervised and controlled by Directorate General of Foreign Trade and regional authorities. And FTP is with effect from 1/4/2023. The current foreign trade policy shall continue to be in operations unless otherwise specified, which means there is no sunset clause. It will be continuing till the time a new FTP is there. And contents of FTP: basic policy plus export incentives. Basic policy contains what is the policy for import of waste and scrap or second hand goods or gifts, etc. Whereas export incentives to exporters, what are the incentives available under the FTP. And we have handbook of procedures, but that is not there in syllabus. Then the forms, Ayat Niryat forms, SION, harmonized system of coding, Indian trade classification. So these are all there in FTP, but we don't have it in syllabus. What we have is only basic policy plus export incentives. Look into the basic aspects of FTP. Under FTP, the imports are classified into 4: Number 1, prohibited, means you cannot import it. Number 2, restricted, you can import but require a license. Number 3, reserved for STE, means anyone cannot import, only those people who are state trading enterprises, they only can import. Example, IOC, ONGC, Food Corporation of India, Multi-Metal Trading Corporation, like that, these people only can import. Then freely importable. Freely importable does not mean that you don't have to pay customs duty. You need to pay customs duty, but freely importable means that a license is not required. Same way exports are also classified: prohibited, restricted and freely exportable. For restricted goods, always a license is required. The name of that license is authorization. That authorization will be given by DGFT, Directorate General of Foreign Trade. So we don't have CBIC in FTP, it is DGFT, whose decision will be final and binding. Directorate General of Foreign Trade, through regional authorities, they will be operating, and this DGFT will be giving the authorization. So license required to import or export issued by DGFT through its regional authorities, and authorization is not a right. So the DGFT has right to refuse or extend, right to refuse to give or to extend. So this particular authorization, either they have right to refuse to grant or renew. License under old FTP will continue to be applicable under new FTP also. And restricted goods imported are subject to actual user condition. Actual user condition means only the one who is importing should use it, and others they should not use it, which means they cannot sell it to others. However, this condition can be relaxed by DGFT, and every importer and exporter should obtain a IEC from DGFT, that is nothing but your 10-digit permanent account number, which will be notified in the portal, that is import export code, and specific provision in FTP or handbook of procedure shall prevail over the general provisions. Then trade facilitation under foreign trade policy, they have created one committee, National Committee on Trade Facilitation. So what this committee will do, it is an interministerial body. So all the ministry like Finance Ministry or Labor Ministry and Commerce and Industry Ministry, everything will be working in close coordination with National Committee on Trade Facilitation. An interministerial body, that is a National Committee on Trade Facilitation, has been constituted to provide the trade facilitation agreement provisions, and they will be having 4 pillars. One is transparency, that is all the import and export related procedures, rules, regulations should be transparent, and it should be technology driven. Nothing should be manual, everything should be automated. And simplification of procedures, so too many documentation should not be involved. And risk based assessment and infrastructure, so that is every time assessment should not be done unnecessarily. Only if there is a risk parameter affected, then only they need to do the assessment, and they need to create a proper infrastructure for the better investment. So that is the aim of this National Committee on Trade Facilitation. Free passage of export consignment, so there are some measures which they have taken. So number 1 is free passage of export consignment. Any consignment which is going outside India should not be searched by the proper officer unless there are some extreme situations in place. Consignment meant for export should not be withheld or delayed for any reason by any agency of central or state government, means GST officer or state VAT officer, anyone should not stop that particular consignment. In case of any doubt, authorities may ask for an undertaking from the exporter and release such consignment. So even if documentation issue is there, the GST officer under section 68 will intercept the vehicle, but they should not seize the vehicle, they should release that. And no seizure of export related stock, no seizure so as to disrupt the manufacturing activity. In exceptional circumstances, based on prima facie irregularities, seizure can be maximum for 7 days unless irregularities are substantiated. Then there is something called as AEO, Authorized Economic Operator Program. So basically those people who achieve good exports from India will be given the AEO status, Authorized Economic Operator status. So it is developed by Indian Customs to enable business involved in international trade to reap the benefits. What are the benefits given to Authorized Economic Operator? Remember, preferential bids. Preferential. What is that preferential? Preferential customs treatment, in terms of reduced examination and faster processing and clearance of cargo. Any goods which are imported by them, they will not be checking any goods, examination will not be there, directly the goods will be cleared. That is called as a green channel clearance. Number 2, B, border clearance privileges in mutually recognition agreement countries, not only in India, so with which India is having mutually recognition agreement, those countries also will be giving them priority with respect to clearances of export goods. And enhanced port delivery, so priority will be given to their goods which are imported, like how baggage, when you are coming in flight, so priority check-in means only those bag will come first now, like that. So authorized economic operator goods only will be unloaded priority, that is enhanced port delivery. And they are eligible for deferred payment of customs duty, so that is 1st to 15th by 16th working day, that facility is there. And they can do self certification, they don't have to go to any officer for attestation of any document, they can do the self certification. So these are the benefits they have. This you mark as important, this can be tested as a short note question. What are the various benefits given to authorized economic operator? Then other measures of National Committee on Trade Facilitation, that is single window system to facilitate export of perishable agricultural produce, because perishable agricultural produce will have a short shelf life, and if you take officers approval from different levels, by the time the perishable goods will get destroyed. So due to that reason there is a single window clearance. Then Niryat Bandhu means export friendly scheme, exporter friendly scheme. Niryat means exporter and Bandhu means a mentor or relative or friend. So hand holding scheme for mentoring new entrepreneurs. And issue of EIEC, import export code. DGFT online customer portal. Sir, online customer portal and all is one achievement, they are writing, that is also one achievement like that. Online facility for ERCMC, then online facility for E-certificate of origin. Remember all forms and you put E like that, so that is the initiative that they have created. And then online facility to file quality control and trade disputes. Electronic record of export proceeds, that is bank realization certificate, foreign invert certificate and all. So we used to get manually, now that is available electronic. That's what, whatever you know, you put electronic, that is the initiative created by them. These are the various measures created by National Committee on Trade Facilitation. What to do when we have not achieved much, whatever we have achieved, we need to blow our trumpet, na? So like that. Then towns of export excellence, which means that, so there are certain towns which have the potential to export, the infrastructure creation and the development will be taken care by the central government, whether the state is considering that place or not, but the central government will take care of that. For example, you know, we have a town called Tirupur in Tamil Nadu, so which is famous for export of garments. So that particular place, whatever infrastructural support that is required, everything will be taken care by the central government, including dumping the labor also in that place from wherever required. You understood or not? Everything they will only take care, and state government don't have to bother about anything about it. So that is this. Selected towns producing goods of 750 crore or more may be notified as town of export excellence. In case of handloom, handicrafts, agriculture and fishery sector, limit will be 150 crores. Common service providers in these areas shall be entitled for authorization under EPCG scheme, and units will be provided financial assistance on priority basis. Then next one we have status holder certification, that is a person who is achieving an export performance will be given a star status. So 1 star, 2 star, 3 star, 4 star, 5 star, like that. 5 star status is there. And what is the export performance they need to achieve? So in order to get 1 star status, $3 million, 2 star $15 million, and 3 star $50 million, 4 star $200 million, 5 star $800 million. So this is the turnover they need to, export performance that they need to achieve. So 3, 15, 50, 200 and 800. Remember this number. So because in exam this may be tested. So 3 million, 15 million, 50 million, 200 million and 800 million dollars. And this export performance needs to be achieved. Okay, not in 1 year, not in 1 year. So basically status holder, exporter granted the status certificate in terms of FTP to encourage exporters by recognizing their achievement and helping them build marketing infrastructure and expertise. All exporter of goods and service and technology having IEC shall be eligible for recognition as a status holder, and we need to achieve this export performance in based on current year and preceding 3 financial years. Okay, so status recognition depends on export performance. An applicant shall be categorized as status holder upon achieving export performance, which is counted on the basis of FOB value of export proceeds realized during the current year and previous 3 financial years. So it is not 1 year export. So current year and previous 3 years should be taken, and that should be counted for export performance. And while counting the export performance, export earnings will be taken. Even proceeds realized in Indian rupees wherever permitted by RBI, that will also be counted for export performance. And if there is anything in Indian rupees, that will be converted into foreign currency, because we have the data in dollars. So using the exchange rate prevailing on the 1st April of each financial year, using that exchange rate, it will be converted back to dollars. For granting the status, export performance is necessary in all the 3 preceding financial years, which means that while counting, we take current year and previous 3 years, and once we get one number, that number say $2 million, the $2 million we need to achieve for 3 times, then only we are the 4th year we will be able to get the star status. That is, this is necessary on all 3 preceding financial years. But in case of gem and jewelry sector, 2 preceding financial years. This is about export performance. Okay sir, what are the benefits that will be given to the status holders? Remember, benefits to status holders: wipes made in India exempted, not wipes, wipes. W for warehouse license to 2-star and above. 2-star and above will get the warehouse license. They can have their own warehouse, that is private warehouse. 2-star and above means except 1 star. Input output norms on priority, that is within 60 days, that will be fixed by the norm committee. And preferential treatment and priority in handling, like how AEO we discussed, preferential treatment and priority in handling. Exports free of cost, they don't have to pay any duty except gems and gold jewelry. And self declaration, this is also there for authorized economic operator. Made in India self certification for 3-star and above. 3-star and above, they can certify that the goods are manufactured in India. They don't have to get the country of origin certificate from the government, and they are exempted from furnishing bank guarantee and compulsory negotiation of documents. So they are exempted from bank guarantee, you remember. So these are the benefits that are given to status holders. And grant of double weightage to achieve 1-star export house status. Following cases are granted double weightage, which means if they make $10 of export, it will be counted as $20. So MSMEs, manufacturing units having ISO or BIS certification, units in northeastern states, Sikkim or Jammu and Kashmir, Ladakh. Then export of fruits and vegetables, only for these 4 people, that too to achieve 1-star status. Thereafter, if they make $10, it will be counted as $10 only. Then stakeholder consultation by government, it is an amendment, this can be tested in exam, and they have created one question also related to this. So government may ask for suggestion from exporter, importer and experts while making or changing the foreign trade policy. And if suggestions are asked, 30 days may be given to respond. So as and when they are seeking any stakeholder consultation, that means they can ask the changes to be made in the policy, and they will give 30 days to respond. However, government can make changes without asking anyone, then why they gave this provision? Then if suggestions are not accepted, so suggestions may not be accepted, but the government may explain why, but only if it wants to. So what are the cases where reasons may not be explained? If whatever suggestion you gave that is going to affect the relationship with the other country, like you tell that, so don't import anything from US, like that you are telling, so that they may not take, so because they need to maintain the relationship. Or they will tell, so ban all China goods in India, so that they may not take, because that is going to spoil the relationship and security of the country. It affects the trade with other countries or national security. They may not adopt to your your suggestion, and they don't have to give reason also why they are rejecting your suggestion. It goes against the government policies or plans. It's irrelevant or benefits only few people, and it requires sharing confidential details. In these cases, they may not explain the reasons, and no one has legal right to demand reasons if their suggestion is not accepted. So this is about stakeholder consultation by government. Then specific provisions relating to import and export. First sample, see, you have to remember here the general rule. The general rule is that if you are importing restricted goods, that require license. If you are importing freely importable goods, that do not require license. So restricted requires license, that is authorization. Free does not require authorization. This is general rule. Wherever there is deviation, that only you need to remember. Samples, you are importing samples. That samples are defense items, defense or security items, seeds, bees or new drugs. definitely authorization is required. Whether it is restricted or not, no need to check. 4 goods. What are the 4 goods? Defense items, security items, seeds, bees and new drugs. So this require authorization. Other goods does not require authorization. So we don't have to check whether it is restricted goods or freely importable goods. So this is the policy that we need to adopt. Whereas export of trade samples, if it is restricted goods, general rule that requires authorization. If it is freely exportable goods, that do not require any authorization. So therefore, this is what you need to remember. Remaining is general rule. Okay, 90% of the cases, if you write the general rule, your answer will be correct. Okay, only these specific situations you just listen to once. And duty free import of samples, you can import the samples without payment of customs duty. To what extent you can import? Up to 3 lakhs for all exporters shall be allowed. Then import or export of gifts. In case of import of gifts, you are importing gifts, you don't know what product it has, so therefore you are getting it. And suppose if it is through post or courier, including e-commerce, only Rakhi and life-saving medicines is allowed and that does not require authorization. All other goods are prohibited, means you cannot bring it through post or courier including e-commerce. Then how it should come? Like a regular cargo only it should be imported. All other modes only it should be imported and authorization not required. But remember, if it is through post or courier including e-commerce, other than Rakhi or life-saving medicines, it will be prohibited. And in case of Rakhi and life-saving medicines, does not require authorization. Even customs duty also not payable on gifts imported. However, if customs duty in Rakhi is up to 100 rupees, then it is exempted. Generally on gifts imported, customs duty payable. But if the customs duty on Rakhi is up to 100 rupees, then no need to pay customs duty. That is this import of gifts. In case of export of gifts, general rule pa, you know which product you are sending as gift. If it is restricted, definitely that requires authorization. Correct? It's a general rule. So you need to remember only this import point. And if it is export of gifts, so if it is restricted goods, general provision that requires authorization. If it is freely exportable goods, then check what is the value of gift. Suppose if you are exporting freely exportable products as a gift, but the value of gift is more than 5 lakhs in a financial year, what kind of a playboy you are that you are exporting gifts more than 5 lakhs in a year? So we need to check who you are. That's the reason why authorization is required. Up to 5 lakhs, no problem. But beyond 5 lakhs in a year, authorization required even though it is freely exportable goods. Then passenger baggage. This is pakka general rule only. So no issue. Suppose you are importing the baggage. Freely importable goods. Baggage contains restricted goods. Authorization required. Baggage contains freely importable goods. Authorization not required. And you are taking the baggage. Export of baggage. Restricted goods. Authorization required. Freely exportable goods. Authorization not required. But what you need to remember is that in case of import of baggage, even though it is restricted goods, for few goods authorization not required. So that only you need to remember. What is that? Household goods, personal effects, drawings, patterns and other notified goods for export. So these goods alone, restriction, even though it is restricted goods, but authorization not required. All other cases, you follow the general rule with respect to that. Then import of second hand goods. In this import of second hand goods is very, very important area. This will be tested definitely in exam possible. Import of second hand goods. When you are importing the second hand goods, check what it is. Is it capital goods or other than capital goods? If it is other than capital goods, go to that. If it is other than capital goods, this entire chart you need to remember here. This entire chart you need to remember. And if it is other than capital goods, first, authorization definitely require authorization if it is other than capital goods. That is inputs and all, authorization required. However, you are importing for the purpose of doing repair, refurbishing or reconditioning, then anyhow you are going to send it back. So due to that reason, authorization is not required. Whereas you are importing second hand capital goods. Second hand capital goods, if it is AC, air conditioner, diesel generator set, desktop, refurbished or reconditioned spares of computers or laptops, notified electronic goods or used IT assets from SEZ to DTA. So this list you have to remember somehow. These 6 goods you need to remember. What are they? Air conditioner, diesel generator set, desktop, then refurbished or reconditioned spares of laptops or computers, notified electronic items, sale of IT assets from where to where? SEZ to DTA. Definitely that requires authorization. So therefore, you don't have to check what is the new goods imported. New goods imported may be free also, but the moment you are imported in second hand, that requires authorization. Then other capital goods pa. Other capital goods, so you don't need authorization. However, if it is reconditioned or refurbished spares, ensure that the life of those reconditioned spares is at least 80% of the residual life of the original spares. That alone we need to ensure. And capital goods which is used abroad in a project for at least 1 year can be imported for setting up a project in India without any authorization. That is, you are shifting your company completely from there to here. So then capital goods can be brought and no need of any authorization in that case. Then prototypes. Prototypes are basically like working model of a particular product which is imported, and using that prototype we will make the reproduction or manufacturing, etc. For example, so in order to make the car, they will be importing a prototype of the car, and once the car prototype is imported, exactly like that they will be making the car in India, because in India also the global companies are having the plants, so they will be manufacturing in India. Only difference is that there it will be right hand drive and here it will be like a left hand drive, correct? Difference. So here it will be right hand drive and there it will be left hand drive. So due to that reason, that alone they will change, but completely because of that, so everything will change. So therefore the regular IP whatever they have, that will not be used for cars manufactured in India. So they make a working model of that right hand drive car and they will be sending it to India, and using that they will be replicating that in India. So due to that reason, that prototypes which are manufactured, like imported by the manufacturer, should be used only in India and it should not be sold to any other person. The actual user condition is there. So new or second hand prototypes or second hand samples may be imported without any authorization. Without any authorization, no need of any authorization on the following conditions. What is the first condition? Actual user condition. Means a manufacturer who is importing only should use it, and he is engaged in production of having industrial license or letter of intent for research, and the importer files a self declaration to that effect that they will not be using it for any other purpose but only for manufacture, like that. Then authorization is not required in that case. Metallic waste and scrap, definitely authorization is required, because in the form of waste, e-waste and medical waste or any other metallic or radioactive contaminated waste will be imported. So authorization is always required. Suppose if that metallic waste contains any radioactive materials, it will be prohibited. So that will not be allowed at all. Then import for export, this is the general rule. First it is freely importable freely importable. Whether there is freely exportable or restricted for export, authorization not required for import. Why? Because it is freely importable. General rule. Same way, it is restricted for import. Whether it is freely exportable or restricted for export, as it is restricted for import, authorization required for import. Then as it is restricted for import and restricted for export, authorization required for both import and export. So just for this, you remember the general rule, that is sufficient. And next, if you are importing any goods or purchasing locally manufactured goods, indigenous goods, and you are exporting it for repairs, testing, quality improvement, upgradation, again when you are re-importing, if it is restricted goods, that requires authorization. But already we imported, at the time we have got the authorization. Even on re-import also you need authorization. And freely importable, authorization not required. So remember, at the time of import, whatever the treatment is there, the same treatment on re-import also, and again you need to get a fresh authorization. Then these are the points, basic policy. Now we are looking into export incentives. So these are the various export incentives that you need to keep in mind, and these export incentives I have just given in a tabular format, and if you are having the old book, and the PDF of this will be available in the Telegram group, anywhere you can just check it. If you are having the new book, so it is there in the new book. If you are having old book alone, you please download it somewhere. So in the Telegram group it is there, in our THARUN'S Brainery channel itself, Telegram channel, we have uploaded it. So it is available. Just to scroll or you check the files, it is there. Okay. Then, so what are the various export promotion schemes you can see here? So we have AA, advance authorization, DFIA, duty free import authorization, EPCG, export promotion capital goods scheme, then EOU, EHTP, STP, BTP, then finally deemed exports. So these are the various export promotion schemes. First, advance authorization we will see. You need to learn it column wise, don't learn it row wise, you will get confused. Learn it column wise so that you can learn with the differences. First, advance authorization, purpose is to import inputs without payment of duty for export of goods. So you are having advance authorization means you can import the goods without payment of customs duty. In return, what you should be doing? You must be exporting that goods. I mean imported goods used in production and then export, and applicable to whom? Applicable to manufacturer exporter or merchant exporter tied to supporting manufacturer. You are only manufacturing, you are only exporting, or you are manufacturing, you made a joint venture with a merchant export, so then also this scheme is applicable. But this tying up with the supporting manufacturer merchant exporter is not applicable in case of pharmaceutical products. Means for pharmaceutical products, the one who is importing should only do the manufacture and export it, whereas they cannot associate with any other merchant exporter or supporting manufacturer. And exporter having AEO certificate, exporter with 2-star and above, so these are the people eligible pa. So this all this is are, all this is are, not that these are the and conditions. Okay, so which means you are a manufacturer exporter eligible, merchant exporter tied to supporting manufacturer eligible, or exporter holding a AEO certificate eligible, exporter with 2-star and above eligible. So any of this person is eligible for this advance authorization. What can be imported? Inputs you can import, even spare parts also you can import up to 10% of the CF value of authorization. What is the benefit of import? 100% exemption from all customs duties, safeguard duty, anti-dumping duty, anti-subsidy duty, everything will be exempted. Then next, validity 12 months from the date of issue of authorization plus 12 months only once. Okay, so which means 12 months from the date of issue of authorization. It can be extended for a further period of 12 months, but only once it can be extended, not plus 12, plus 12, plus 12 like that. And in case of deemed exports, it will be 12 months or the project completion, whichever is later, whichever is later. For example, whenever there is an international competitive bidding project, for international competitive bidding project, if the project is going to be happening for 18 months, for example, metro project is an international competitive bidding project, it will take 18 months to complete, then 12 months or 18 months, whichever is later, that is 18 months will be taken as the advance authorization period. Then alternative to import, so you have to make either import or domestic procurement is also possible without payment of GST. That's where in GST, the person who is making sale to advance authorization holder, for that person it is deemed export, so he may not recover any GST from the recipient, or he will recover and the recipient will get full refund. That we have seen there in deemed export, that is a connection. So domestic procurement without payment of GST. And export obligation. What is the export obligation that they need to achieve? 15% value addition. 15% value addition means the FOB value of export should be greater than or equals to CF value of import into 115%. Okay, so that is, say for example, we are importing and the value of the goods imported is 1 lakh. How much should be the export value? 1,15,000 should be the export value. Can make export including supply to SEZ, deemed export, supply as stores to foreign going vessel or aircraft. Okay, so they can make export, or they can make supply to SEZ, or they can even do deemed export. All this is counted for export obligation. They can make deemed exports, or even they can make supply as stores to the foreign going vessel or aircraft. The foreign going vessel or aircraft is leaving now, for that they can sell it as stores, spare parts or stores or consumables, like that they can make the sale. Then one point, notional value of material supplied free of cost by the buyer including the CIF and FOB. For example, you are the exporter and you have got the buyer who is giving the free of cost material, so that is imported. So that free of cost material imported should be added to the CF value of import, and it should be added to the FOB value of export in order to count the value addition. Got it? And it should be included in both CF value of import, FOB value of export, while determining the value addition of that 15% value addition point. Notional value of material supplied free of cost by the buyer including both CIF and FOB. Then consideration. How the consideration should be? Definitely it should be in convertible foreign exchange. Can the license be transferred? No, the license should not be transferred to any other person. Means those who are having advance authorization, they can only do the import. Whether imports are subject to actual user condition, yes, the license they cannot transfer. Moreover, the goods imported under that license also cannot be transferred. Then that is the meaning of subject to actual user condition. Then other conditions to be fulfilled. Standard input output norms should be notified. if there is no standard input output norms for the industry, they need to request for getting the standard input output norms. On priority it may be given for that, like star status, export standard input output norms on priority within 60 days, like that one point is there na, so that will be given to them if SION is not notified for that industry. For additional inputs beyond SION, authorization on the basis of self declaration and self ratification, and they need to get a certificate from a chartered engineer as to how much of the inputs are necessary to make the export of the finished goods. And next, pre-import condition. Pre-import condition means what? Input shall be procured prior to manufacture of the export item. And export obligation period. What is the export obligation period? 90 days from the date of import. So that is with respect to this. And then not applicable to whom it is not applicable? Specified exports. It is not applicable to specified exports or import of specified inputs based on risk management. DGFT may reject, or prohibited items and items reserved for STE. So in these cases it is not applicable. So they will mention certain goods, AA is not possible, or import of specified raw material it is not allowed, or based on risk management they may reject, or prohibited items or items reserved for STE, that is also AA not applicable. So these are all the points that we have in advance authorization. Then, and in your study material also the same is there. So this chart is prepared based on your study material only, don't worry. I did not take it from ChatGPT or anywhere. So all these are based on study material, these are the points. Only thing I have put the effort in order to connect the one point to the other point, so it will become easy for you. Otherwise, lot of pages of information is there in study material related to this. Then DFIA. What is the purpose of DFIA? To import inputs without payment of duty for export of goods. Same. So in DFIA also you will import the raw material without payment of duty. In turn you have an export obligation to do the export. So the same purpose of AA, DFIA also. But to whom DFIA is applicable? Manufacturer exporter, same. Merchant exporter, whether tied or not to the supporting manufacturer. But in case of AA, only if they are tied to the supporting manufacturer. Here, whether tied or not to the supporting manufacturer. What can be imported? Inputs can be imported. And benefit of import, but here spares can be imported, but under DFIA only inputs. And benefit of import, only 100% exemption from basic customs duty, but other duties and all is payable. But under AA it is best 100% exemption from all customs duties. Then validity 12 months from the date of issue of authorization, that is a validity. Alternative, they can even do the domestic procurement also like AA. So even DFIA holders also can do domestic procurement. If I make sale to them, for me it is deemed export. And what is the value addition? 20% value addition, which means that FOB value of export should be 20% more than the CIF value of import. Then consideration in convertible foreign exchange, yes. Can the license be transferred? Yes. That is the advantage. Whereas in case of AA, license cannot be transferred, but here license can be transferred, means other person also can do the import under DFIA. And whether the imports are subject to actual user condition, no. Even the raw material you imported under DFIA can be sold to any other person. And only for products for which SION is notified it is possible, and it is issued on post-export basis, which means like first you export, use the raw material in that, and how much raw material you used in export, that much raw material subsequently you can import without payment of duty, which is used for next export. Means first time you need to import raw material with payment of duty, use it in export, prove that you are exporter, to what extent you have used in raw material in that export, that much of raw material you can import without payment of duty, which will be useful for subsequent exports. Application made before starting the export. Merchant exporter should mention the name of the supporting manufacturer in the documents. Then only, merchant exporter will export, but the import will be made by the supporting manufacturer. Otherwise, the supporting manufacturer will not get any benefit here. Regional authority shall issue a transferable DFIA. Export obligation is within 12 months from the date of filing online application. But here just 90 days. 90 days they need to achieve. But here no, 12 months, because basically here you are not importing first. First you are exporting only, and then only the import is happening. Then next one. So not applicable to import of tires. For tires it is not applicable. Inputs which is subject to pre-import condition, DFIA is not available. Then next one, EPCG. EPCG refers to export promotion capital goods scheme, and the purpose AA and DFIA is for raw material, whereas EPCG is for capital goods, to import the capital goods without payment of duty for export of goods. And it is applicable to whom? Applicable to manufacturer exporter, merchant exporter tied to supporting manufacturer, and to the service providers it will be available. So extra what we have is that like AA, manufacturer exporter, merchant exporter tied to supporting manufacturer, merchant exporter tied to supporting manufacturer. Here not applicable for pharmaceutical products, here for pharmaceutical products also it is possible. And service providers extra we have. And what can be imported? Any capital goods. How service providers will import capital goods like computer system, data centers, etc., including computer systems, spares and molds and jigs and fixtures, all those things. And benefit of import like AA, 100% exemption from all customs duties, and validity 24 months from the date of authorization, means once they give the authorization, within 24 months they can do the import of capital goods. Alternative to import, they can even do domestic procurement also without payment of GST. So therefore I am a seller, I am selling capital goods to EPCG holder, for me it will be treated as deemed export. And what is the export obligation? They should achieve average export obligation and specific export obligation. Average export obligation is that every year they need to maintain the average of the preceding 3 financial years, that they need to achieve. In addition to that, if they achieve anything beyond that, that will be counted towards the specific export obligation. What is the specific export obligation? 6 times the duty saved. For example, the duty saved is 40 lakhs. 40 lakhs into 6 is what? 40 lakhs into 6, 240 lakhs. 240 lakhs is the specific export obligation. But the problem is that 240 lakhs is not your exports. 240 lakhs is an amount beyond the average export. For example, year 1 average is 40 and you achieved 60, means that extra 20 is there na, the 20 only will be counted for specific export obligation. Like that every year we need to take the average. How to determine the average? Based on the last 3 years, and beyond that whatever you are making, that will be counted towards the specific export obligation. And how much is your specific export obligation? 6 times the duty saved you need to achieve. So 6 times the duty saved, and average is each year export should be average of preceding 3 years, and this specific export obligation is over and above average export obligation, and they can make either exports or deemed exports or services also, and even exports under other schemes like AA, DFIA will also be counted for EPCG. Exports under other schemes also counted for these exports. And if you are making domestic procurement, your specific export obligation will be 4.5 times instead of 6 times. That is 40 lakhs we discussed now. 40 lakhs into 4.5 only you need to achieve specific export obligation if you are purchasing the capital goods locally. Okay, even then you are not going to pay any GST, but you have to achieve the export. Average you need to maintain plus specific export obligation will be 4.5 times the saved, duty saved or tax saved, 4.5 times the tax saved. Then can the license be consideration? Definitely in case of export the consideration should be in convertible foreign exchange. Can the license be transferred? No. And whether imports are subject to actual user condition? Yes, till the export obligation is completed. What are the other conditions to be fulfilled? Capital goods can be used in pre-production, production or post-production, and export obligation within 6 years from the date of issuance of authorization, means that export obligation is there na, 6 times the duty saved. You need to achieve in how many years? 6 years. It's not to be achieved in 1 year or 2 years. And suppose if 75% of specific export obligation is fulfilled within 3 years, then remaining 25% is relaxed. For example, you are saving 40 lakhs, 40 lakhs into 6, that will be 240 lakhs, 240 lakhs into 75%. If you are able to achieve in 3 years, then the remaining 3 years you don't have to achieve anything. Got it? Means export obligation is completed. How much you need to achieve? The specific export obligation means maintain the average. Maintain the average, and beyond that it should be 75% of the specific export obligation. The remaining 25% will be relaxed. Not applicable to restricted capital goods without any approval if it is imported. So then that cannot be. So restricted capital goods without approval cannot be imported. That is with respect to EPCG. Then EOU, EHTP, STP, BTP. So you can see there. First, what is the purpose of this EOU schemes? to import inputs or capital goods without payment of duty for export of goods. Under this scheme, both import of inputs and capital goods is allowed. And to whom it is applicable? EOU, export oriented unit. And what is the minimum investment criteria? They should make 1 crore in plant and machinery. However, board of approval may allow lower investment criteria also. Then EHTP, Electronic Hardware Technology Park, STP, Software Technology Park, BTP, Biotechnology Park, and any type of business including repair, software, agriculture is allowed. But remember, under these EOU schemes, trading is not allowed. So trading units is not allowed, and prohibited goods should not be manufactured and exported. Except trading and prohibited goods, all other sectors are allowed in this case. Then what can be imported? Either inputs or capital goods can be imported. Benefit of import, 100% exemption from all customs duties. Total customs duties is exempted. And next, validity 5 years, which means that the 5 years they have to get the license for 5 years in a block of 5 years. And remember, in that block of 5 years, they need to achieve a positive NFE. So they need to achieve a positive NFE. You can see other conditions. NFE should be cumulatively achieved in a block of 5 years from the commencement of production. What is NFE? Net foreign exchange earnings, that is income in forex minus expenditure in forex should be positive. So in that 5 years, suppose in that 5 years they are not achieving that, then their license will be cancelled, and next 5 years renewal will not be there for EOU. So 5 years once the renewal will happen for them. And alternative to import, can they do domestic procurement? Yes, we saw. So whenever a person is making sale of goods to EOU, that is also deemed export under GST. So therefore they can do domestic procurement without payment of GST. Export obligation. So yes, they need to achieve the export obligation. And what is that export obligation? We have seen. 1 second. This consideration. 1 second. We don't have any specific export obligation, we don't have any specific export obligation. So here it is like 100%, you write down 100% exports, 100% exports, permissible quantity can be cleared in DTA. Permissible quantity can be cleared in DTA. So 100% we need to make exports, because basically EOU is export oriented unit. 100% exports, but permissible quantity can be cleared in DTA, like waste and scrap, etc. that can be cleared in DTA. Then next, consideration in convertible foreign exchange. Yes. Can the license be transferred? That is not applicable, because EOU is like a status given to a person. You cannot transfer. It's like a building. Okay, license for the building like that. So it cannot be transferred. Whether imports are subject to actual user condition? Yes. The one who is importing only should use it. Other conditions to be fulfilled. First point we saw. And export proceeds should be realized within 9 months. That is time limit under FEMA within 9 months. And inter-unit transfer upon payment of applicable GST, and you can exit from the scheme within these 5 years. But if you want to exit from the scheme within these 5 years, whatever duty that you have saved on import, that needs to be paid. Exit from the scheme subject to payment of duties and taxes saved. Even existing units can be converted to EOU, EHTP, STP or BTP, and not applicable to, already we discussed, trading units or prohibited goods which are manufactured. The last scheme that we have is deemed exports, and one more is there, RODTEP. So that I have given subsequently. So look into deemed exports. What is the purpose of this deemed exports? Basically, rather than selling the goods to outside India, if you make sale to certain projects or certain people in India, that will be counted as deemed exports. So sale of manufactured goods in India to specified projects or specified customers. So who are those specified projects or consumers? Number one, sale to an advance authorization holder. You are advance authorization holder. If I am making sale to you, for me it is deemed export, not only under GST but also under FTP. Number two, sale to EOU, sale to EPCG. So first three, AA, DFIA, EPCG, EOU, those columns. AA, DFIA, EPCG, EOU, when I am making sale to them, so for me it is deemed export under FTP as well as under GST. Then there are 4 projects: nuclear power projects, and then mega power projects, and projects financed by UN or international organization, and international competitive bidding projects. So to those projects, if I make sale also, it will be deemed exports under FTP. It is not deemed exports under GST. So total we have 7 sales which will be considered as deemed exports. Then what can be imported? Either inputs or capital goods can be imported. What is the benefit of import? Import under advance authorization or DFIA. So that is, I am making deemed export. I can import under advance authorization without payment of customs duty. That is, I am making sales to you, you are advance authorization holder. You can procure from me, and I can import the raw material without payment of customs duty under AA or DFIA, or I can pay customs duty. When I am making sale to you, I will get deemed export duty drawback. Whatever customs duty paid on import, that I will get as a refund. So import, either import under AA or DFIA, or pay customs duty on import, upon sale get deemed export duty drawback or refund of terminal excise duty. So these are the benefit in case of export. And validity, the validity will be up to project completion. And alternative to import, what they can do, so rather than import, I can even locally procure also, domestic procurement. But the problem is upon payment of GST. Everywhere you saw domestic procurement without payment of GST, without payment of GST, without payment of GST. But in this place, it is upon payment of GST. Then export obligation, yes, they need to achieve the export obligation. That is either inputs or capital goods, they need to make the exports. But here, sorry, export obligation is not applicable because they need to make sales to the projects. They need to make sales to the projects or persons in India, so that is not applicable. And consideration in convertible foreign exchange, not applicable. It can be either in rupees or in foreign currency. Can the license be transferred? Not applicable. Import subject to actual user condition, not applicable. Other condition, supplies shall be made directly to the entities. So, or supplies can be made at the project or site. Either we can sell it to them, or to their projects or site we can hand over the goods. But remember, when it is not applicable, third party supply. Third party supply means subcontracting is not allowed. Subcontracting means what? Suppose if I enter into contract with you, I only should supply. I cannot outsource it to some other person, and he cannot supply to you, and he cannot treat it as deemed export. If suppose if he need to sell, he need to first sell it to me, and I need to sell it to you. That is only allowed. So third party supply, that is subcontracting, not allowed. However, they can supply to the main contractor, and in turn that can be supplied to the projects. Then look into advance authorization for annual requirement. Like that one model is there. Basically, advance authorization normally is that you need to tell how much you are making exports. So based on that, they will be giving you the permission to import. But I don't want like that. I want some quantity that I can import, and that I will use it in export. Every time I cannot ask the permission or request, etc. For that, they created advance authorization for annual requirement. So shall be issued for items notified in SION, and it shall not be available in case of ad hoc norms under self-declared authorization where SION does not exist. So first condition, SION should be notified. What is SION? Standard Input Output Norms. Number 2, advance authorization for annual requirement shall also not be available in respect of SION where input is notified. Okay, so where there are some notified goods for which this is not eligible, so for that also you cannot. And next, exporters having past export performance. How much should be the past export performance? In at least 2 preceding financial years shall be entitled for advance authorization. Suppose if they start business only this year, they are not eligible. They should be exporter having some export performance in the last 2 years. And entitlement, how much they can import? How much they can import? So they can import 300% of the FOB value of physical export or deemed export in previous year. For example, previous year my export is somewhere like 20 crores. 20 crores into 300%, that is 60 crores or 1 crore, whichever is higher. What if my export is just 60 lakhs? 60 lakhs, even then 60 lakhs into 300%, that is 1.8 crores or 1 crore, whichever is higher. So to that extent, I can import under this advance authorization for annual requirement. Then fulfillment of export obligation. How to count the export obligation? Export obligation will be, so based on FOB value of export and CIF value of import, that should be taken. And in case of CIF value of import, import under all schemes should be taken. Not only imports covered by authorization, even imported material under which duty drawback is claimed also should be counted. And this point already we discussed. In case of free of cost material supplied by the buyer, we need to include it in both FOB value of export and CIF value of import. Then remission of duties and taxes on exported goods, RODTEP scheme. So to whom this RODTEP scheme is available? Refund to exporters. So basically RODTEP scheme is like you are importing some goods or you are locally manufacturing some goods based on the imported raw material and you are exporting the goods. So when you are exporting the goods, the major taxes like GST and the customs are already covered under the incentives. But there are some local taxes like professional tax or municipal tax, etc. To give you the relief from that also, what they are telling, as you have some local levies, a small percentage of the FOB will be given to as an incentive to ease out the local tax burden. So refund to exporters, central or state and local duties or taxes that were so far not being rebated or refunded. What are they? Corporation tax, municipal tax, mandi tax, local body tax, garbage tax, like that. All these are local taxes levied in various state governments, and refund credited to electronic duty credit ledger. So depending upon your FOB value of export, a percentage of your FOB value of export will be given to as incentive. That incentive where they will give? In electronic duty credit ledger through a e-script maintained under section 51B, which can be used only for payment of basic customs duty on import, or it can be transferred to other importers. How the rebate will be given? The rebate under this scheme shall not be available in respect of duties or taxes already exempted, remitted or credited. Means already customs duty benefit you are recovering and already GST benefit you are recovering. So only for local taxes they will be giving. What if a product don't have the local tax burden? Definitely RODTEP is not applicable. Example, you are importing goods from one country, exporting to other country, you did not locally manufacture, there is no local tax burden on those goods, RODTEP is not applicable for those goods. Are you understanding? Then under this scheme, a rebate would be granted to eligible exporters at a notified rate as a percentage of FOB value with a value cap per unit. So it will be like 1% of FOB, 2% of FOB, subject to maximum 2000 rupees per kg, like that, and all it will be given. And here for certain export items, a fixed quantum of rebate amount also may be notified, and the rebate is allowed subject to receipt of sale proceeds within the time allowed under FEMA, failing which such rebate shall be deemed never to have been allowed. The rebate would not be dependent on realization of export proceeds at the time of issuance of rebate. What is it they are telling? First you are exporting, you are eligible for the rebate, not necessary that you need to realize the proceeds, you will get it, but you should ensure that you are realizing the proceeds within the time limit under FEMA. If you fail to realize the proceeds within the time limit under FEMA, the rebate that has been granted to you will be recovered from you. Even though that scrip is not with you, you might have transferred to transferee, but from the transferor only, that is to whom initially the rebate is given, from that person only it will be recovered. If the sale proceeds are not realized within the time limit allowed under FEMA, then the rebate granted shall be recovered from the person to whom rebate is granted, even if such duty credit is transferred to any person. And who are all ineligible in this scheme? So export of imported goods, you are importing goods from one country and exporting to another country, I told you already. And export through transshipment, because in all these cases, just keep in mind, there is no local tax burden. As there is no local tax burden, you will be getting the relief in this case. Number one, imported goods exported to some other country and export through transshipment. Export goods subject to minimum export price. There is a minimum export price fixed by the government of India. In that case also this is not applicable. Restricted goods or prohibited goods. Why minimum export price? Because in that case already you are getting the relief. So they are fixing the price considering all these things. So therefore they fix the minimum export price. In that itself you will recover all the local tax and duties. Whereas prohibited goods and restricted goods not possible. Deemed exports, the goods are still in India, so not applicable. And supply of products manufactured by DTA to SEZ, sale to SEZ also not eligible. Products manufactured wholly or partly in customs bonded warehouse. These are the cases where RODTEP scheme is not eligible. And next, penal action and placing an entity in denied entity list. Suppose if a person has breached the conditions of FTP or has not fulfilled the export obligation, then he will be liable to penal action under FTP, that is Foreign Trade Regulation and Development Act, and he violates any condition, fail to fulfill export obligation or fail to deposit the requisite amount within the prescribed period, then he will be liable for penal action. And even any information which he need to furnish, he furnished but it is found to be untrue or incorrect, so then also he will be levied with a penal action. And apart from penalty, his name will be mentioned in the denied entity list, so that next time when he apply for any authorization or any license will not be given to him. That is, the firm may be refused to grant or renew of any license or authorization or scrip or any instrument. All new licenses so will be blocked from printing or issue or renewal, and only when he complies with all the regulations and pay the penalty etc., then the firm's name can be removed from denied entity list by the concerned regional authority for reasons if the firm completes export obligation, pays penalty, fulfill the requirement of demand notice. So this also, once they have asked, write a short note on the penal action that will be levied and placing the entity under denied entity list like that. With this we completed FTP. Okay, so we completed literally everything. GST and customs, nook and corner, every topic I have discussed with you. Okay, so we'll take a break and then we will continue with the remaining portion, that is Mighty 50 discussion and the other aspects. Okay, and customs case law summary already I did in the past, there is no change in that. That video is there in the playlist. I will just add it to this playlist, that video, you can just watch it. Okay, hardly it is some half an hour video, not more than that. So quickly you can just watch it once and go for the exam. Okay, so we'll see after 10 minutes. Is it raining here outside? Huh? That AC you turn off, it's up to you. If it is raining, no, we'll try to wind up early. Okay, we'll continue. So I have given mighty 50 questions for JAN'26 exam, and this PDF also I have shared for those who are watching online. It is there in the pinned message and it is there in our website also. You can download that. And these 50 questions, not that these 50 questions only will come for exam, definitely, because I need to give the disclaimer, because many students will learn these 50 questions only and will go for the exam, and thereafter they will complain to me that sir, I have followed your mighty 50 but nothing came from that. If every question from mighty 50 comes, then mighty 50 I will be publishing for 10,000 rupees or 20,000 rupees, so that from literally like exam question paper I can sell, thereby I will be making some good gain out of it. But no, definitely no. What I did is that based on my analysis over the various past exam questions, so I feel like these are the probable areas which can be tested considering the amendments, etc. and all. So this give you the wide coverage of all the questions, all the portions. So touching all the portions, I have just made the questions, but that does not mean only from this the question should come in exam. Okay, then so in this, the first aspect I wanted to discuss with you is how to present this 14 marks question. So we will discuss that first, and we will do one question also related to this in mighty 50 I gave. So whenever you get this 14 marks question, which is comprehensive question, computation of net GST payable, so this first statement is that you need to prepare a gross GST payable on outward supplies. So total 4 statements you need to make. Can you turn off that? So total 4 statements you need to make. Number 1, gross GST payable on outward supplies, that is statement number 1. Statement number 2, GST payable on inward supplies under RCM. Statement number 3, that is ITC availed and reversed. Statement number 4, computation of net GST payable. These are the 4 statements. So first statement is what? Gross GST under FCM. Second, inward supplies under RCM. Number 3, ITC. Number 4, computation of net GST payable. So look into the gross GST payable on outward supplies. You prepare the table with these columns: particulars, value, CGST, SGST and IGST. Why value column is required? Because in order to check whether rule 86B is applicable or not. Second, in order to know the exempted turnover and total turnover. So this column will be useful. First, we need to take the transaction, whether it is supply or not a supply, we need to check. Suppose if it is not a supply, just you need to write the note that the said activity is not a supply. And suppose if it is supply but it is exempted, then also you write the note that it is exempted properly. In the table itself you write, don't write the note separately below the table, but inside the table itself you write down the notes, that is as per section 11 read with notification 12/2017 the said activity is exempted, like that you need to mention. Then if it is a supply which is taxable under RCM, then also you just write a note, don't compute any liability. In the first case, when it is not a supply, don't take it in the value. Why you don't have to consider in the value? When the activity is not a supply, it will not come anywhere in exempted turnover or taxable turnover, anywhere it will not be coming. So liability also you don't have. Suppose if the supply is exempted, then you need to write a note and take in the value, because it will be counted for the purpose of exempted turnover, while ITC reversal and liability will not arise. Supply covered under RCM, it is not taxable in your hands, it will be taxable in the hands of your recipient. So don't take it to your liability, but count it in the value. For what purpose? Supply under RCM is treated as exempted supply. For that purpose, supply under RCM is treated as exempted now for ITC. For ITC calculation, supply covered under RCM is treated as exempted. So therefore you need to count it in the exempted, treated as exempted for ITC. So you count it in the value, but you don't take it in the liability. Then supply which is taxable under FCM, which is intra or inter, accordingly you take it into your liability. Is that clear? Suppose if it is intrastate or interstate, depending upon that you take it into the liability and you will get the total. This is called as the gross GST payable on outward supply. Exempted turnover is useful for ITC reversal. Taxable turnover is useful for checking the applicability of rule 86B. Okay, for rule 86B purpose it will be useful. and exempted turnover is useful for ITC reversal. That is with respect to this first statement. Then second statement, computation of GST payable on inward supply under RCM. So you need to analyze all your inward supplies. Again you need to check whether it is supply or not. You have an inward supply but it is not a supply. You are not required to pay GST on that. So therefore it will not be coming in this statement. Second, it's an inward supply but it is exempted. Again it will not be coming in the inward supply under RCM. Whereas if it is an inward supply taxable under FCM, that will also not be coming here, because what you are going to determine is inward supply covered under RCM. So that will not be coming in your statement. So when it will come, inward supply which is taxable, on which you need to pay GST under RCM. So in this second statement you need to be strong with respect to section 9 subsection 3 read with notification 4 of 2017 and 13 of 2017. Okay, and you need to accordingly take. Now in this regard there is one important aspect, whether IGST paid on import of goods, will it be counted as your RCM liability, for which in CA Institute multiple questions, they have taken multiple treatments. But what you need to follow is that you put it as your liability, RCM liability, but only thing, don't take it into the final statement, final statement, but clearly mention that this RCM liability is payable under ICE gate, that is customs. This RCM, it's your RCM liability only, definitely it is your RCM liability only, but show that it is not a RCM liability payable under GST Act, but it is payable under Customs Act. Like that you just show it. Okay, IGST on import of goods is also part of this statement. Then next, computation of ITC availed and reversed. So what you need to do, first you need to take the ITC. So you are analyzing inward supply. So parallelly you prepare. So when you open your answer sheet, you prepare like first page gross GST payable on outward supplies. Okay. Then next page you take inward supplies under RCM. Third page you take ITC. Now you analyze properly the liability etc. and all, you put it. If you are analyzing inward supply on which GST is payable under FCM, but you check for ITC. It may not come in second statement, but it may come in the third statement because ITC is available. Also, GST paid under RCM will come in second statement as well as in the third statement because ITC is available. In second statement, you focus only about RCM and write the note related to that. In third statement, you write whether ITC is available or not with respect to that. Okay. Then next, inward supply taxable under FCM or RCM. We will avail the ITC. From that availed ITC, you need to take out ineligible ITC. What are ineligible ITC? T1, T2, T3. That is blocked credit, inward supply used for non-business purpose, or inward supply used for exempted outward supply. You need to eliminate that. And once you eliminate that, you will get ITC availed in GSTR 3B. And in the working note, you prepare that D1, D2. That is common credit attributable to exempted supply, common credit attributable to non-business purpose, that also you need to reverse, or any other reversal. Now you need to add the opening balance. But remember, why you should not add the opening balance in the beginning line itself? When you add the opening balance in the beginning line itself, you will think that that is also common ITC, and that also you will do E by F reversal. Got it? Don't do that. So you need to do E by F reversal only on the ITC availed during the month. And then you need to add the opening balance. So you will get net eligible ITC for utilization. This is the third statement. Now fourth statement, computation of net GST payable. You need to take gross GST payable under FCM. From where we will get this data? Gross GST payable under FCM, statement number 1. First statement we will get this data. So gross GST payable under FCM we will get. You take that gross GST payable under FCM minus ITC utilized. ITC utilized. So remember, if 86B is applicable, you need to use 99% of the liability from the ITC. So first, when rule 86B will be applicable, your taxable turnover exceeds 50 lakhs. So that data you will get it from the first statement. Your taxable turnover should exceed 50 lakhs. Second, you have enough balance of ITC compared to your liability. So more or less equal to your liability you have the ITC, then definitely 86B is applicable. Wherein out of my liability, into 99% I will take from the ITC. Out of my liability, into 99% I will take from my ITC. Remaining 1% of my liability I will pay from the cash ledger. Means how much ITC can be utilized? 99% liability can be utilized if 86B is applicable. What if 86B is not applicable? Then 100% liability we can take from the ITC. Then next we need to add GST payable under RCM. Now it is called as the net GST payable using cash ledger. But GST payable under RCM will always be paid under electronic cash ledger only. And remember, this is the place where even IGST paid on import of goods also you will be taking here. But only thing you will show that it will be payable under Customs Act in ICE gate, like that you will mention that. Okay. So this is your net GST payable using cash ledger. This way you present, definitely it will not go wrong. Now let's try to test this, the same format, the same presentation, everything in one question. You please look into mighty 50 questions. Question number 1. 1 Point Supply Private Limited, a registered entity under GST in the state of Maharashtra, is engaged in various supplies. It provides the following information for the month of April. And we have got the outward supply data, inward supply data separated and given. But in some questions, they will not separate and give. They will merge. You need to identify whether it is outward supply or inward supply. That is the first aspect you need to do. Because, while interpreting, if it goes wrong, it may go in different statement, because of which the answer will go wrong. So that's the reason why. But here in this question, they gave outward and inward. But even then, you need to check for whether it is supply or not a supply. Okay. Supplied a consignment of 50 power drill kits to build Pro and Sons in the state of Maharashtra at the instruction of Messrs. Tool Mart of Tamil Nadu. First, it is a supply because there is a consideration. Now, it is your outward supply. We don't have any exemption in this regard. Moreover, for goods PA, only when it is given as exempted, it is exempted. Otherwise, it will be taxable. So, goods related exemptions we don't have. So, unless it is given in the question as exempted, in case of goods, always you assume that it will be taxable. So, it will be taxable. Now, whenever it is taxable, covered under FCM or RCM, you need to see. Definitely it is FCM because it is not covered under the notified goods, because we have notified goods for 2017. Nowhere it is there. The sale is not there in that. Am I right? So, it is not covered under RCM. So, it will be FCM. First, what we checked? The supply we checked. Next, what we check, is it taxable or not? What I told you, by default, all goods will be taxable. For mighty 50 questions, I will go little slow only. Okay. So, because, I need to explain the concept, etc. and all, and lot of students need to do that for that reason. Okay. So, first, we need to check supply. Second, we need to check, is it taxable or exempted? All are taxable. Number 3, is it FCM or RCM? We need to check. So, by default, it will be FCM because these are not covered under RCM for 2017. So, it will be taxable under FCM. Now, we will take it into the column. But the problem is, that is statement 1, it will come. It will come in statement 1. But is it FCM, CGST, SGST or IGST? That we need to check. For that purpose, what we need to see? Place of supply. So, only through place of supply you will know. It will come in statement 1, but where? CGST, SGST or IGST, that we need to see. So, place of supply in case of goods. This is place of supply in case of goods. On the instruction of, the moment you see this word on the instruction of, no doubt it is a bill to ship to transaction. In case of bill to ship to, what will be taken as the place of supply? Billing address. So, for this person, what is the billing address? At whose instruction? On the instruction of Tool Mart Tamil Nadu. The one who gave the instruction is the billing address. So, billing address will be Tamil Nadu. Where is this person located? Maharashtra. Therefore, it is interstate supply chargeable to IGST. So, where it will come? Statement 1, 6 lakhs into rates. What is the rates of GST? 9%, 9%, 18%. So, IGST is 18%. So, we need to put it in the last column. So, see the answer. Statement 1, computation of gross GST payable on outward supply under FCM. Consignment of power drill supplied at the instruction of the third person. Since it is a bill to ship to transaction, you need to write about that and determine the place of supply and value 6 lakhs. So IGST 6 lakhs into 18%, 1,08,000. Done. Second transaction. Supplied silk yarn manufactured from silkworm cocoons to Silk Aura Creations for manufacturing sari. Silk Aura Creations is not registered under GST. Invoice for this supply contains the address of the factory of Silk Aura Creations located in Nasik, Maharashtra. Why is it exempted? We don't have any exemption with respect to this, correct? It will be taxable. Goods unless it is given as exempted, it will be taxable. Okay. Moreover, here silk yarn by silk yarn manufacturer, supplied silk yarn manufacturer to registered person is RCM. We have list of notified goods for 2017. In that, sale of silk yarn by silk yarn manufacturer to registered person is covered under RCM. Here it is silk yarn manufacturer only, but not to a registered person. It is to unregistered person. So it is not covered under RCM. It will be FCM. So first taxable, it is supply, taxable, it is FCM, and who will pay GST? Supplier will pay GST, and where it will come, intra or inter. Now again we need to determine the place of supply. What is the place of supply? Maharashtra, ending point. So we don't have any information. Supply involves movement of goods. So therefore we need to take supply involves movement of goods B to C. B to C. So 10(1)(a) supply involves movement of goods 10(1)(a), but location of recipient in the records of supplier should be taken. If it is B to B, ending point. But if it is B to C, location of recipient in the records of supplier. What is the location of recipient in the records of supplier? The supply contains the address of factory of Silk Aura Creations, Maharashtra. Again, it will be interstate supply. So you can see 4 lakhs. You need to take 10(1)(ca). Be careful. The section code, what you are quoting and the explanation you are writing is so crucial for the marks. Okay. And you know what they are doing? If this explanation is wrong, at least previously half mark they used to give, but they are not giving marks. They are not giving marks. Previously they used to give half mark. But in the recent 2 attempts, what I have observed is that if there is a mistake, mark gone. No mark. No mark or yes mark. Okay. So that's why. So be careful with respect to what is the explanation that you are writing. And therefore it is not covered under RCM. That point also you need to write. What is that? Further tax payable under forward charge since silk yarn is being supplied to unregistered person. So it will be coming under, where is the supplier located? Maharashtra only, sorry. Maharashtra, and place of supply also Maharashtra. It is intrastate supply, CGST and SGST. Next. Provided complimentary training at Kalyani Village Resort, Mumbai. Training, okay, Maharashtra, to its agents within Maharashtra on effective handling of customer queries. Open market value of the said service is 2,60,000. Value of supply of service of like kind and quality 2,50,000, 9 lakhs. First, is it supply? Is it supply or not a supply? That you need to check, because I told you, horror movie example. What is that? All the data will be directing you to commit the mistake. Be careful, because first of all you need to check, is it supply or not a supply? Principal agent. Principal agent, for consideration or without consideration? Huh? Principal agent, complementary training. So, without consideration it will become supply if it is goods. It is service. Training, okay, it's a service. So it will not be first of all supply. Correct? So say this. Free of cost training to agent. Services supplied by company to agent without consideration is not deemed as supply, since only goods, I stress this point while discussing, only goods supplied by principal to agent are covered therein. You got it? So it will not be covered under principal agent transaction. But if you see the data, 9 lakhs they give. 9 lakhs they give. First trap, we may think it for consideration. And unless otherwise this complementary word you are not reading, you will not understand. You need to know English. What is complementary? You need to know. First trap 9 lakhs. Second trap, principal agent transaction, related party transaction, like the 29 you will take. Open market value, okay, or 90% of resale price. All those things we will think. Hana, first it is not at all a supply. You got it? So that's what. So trap and all they will put like this nicely. So it is not at all a supply. Then next, but you need to write the note that it is not a supply. 4. Transfer the tenancy right of a commercial complex taken on rent located in Mumbai for a tenancy premium to Nexus Source Limited of Kanpur, Uttar Pradesh. Stamp duty and registration fee have already been paid on the tenancy premium. What is the treatment of tenancy premium? So whenever the tenant, are they tenant? Yes. So whenever the tenant transfers the tenancy premium, definitely it will be taxable in the hands of the tenant. Even though the tenancy rate is registered and stamp duty is paid or not, it will not come under sale of land. Just because stamp duty is paid, it will not become sale of land. It is subject to GST and it is a service, but that service is in relation to immovable property. Tenancy rate is in relation to immovable property. What will be taken as the place of supply? Location of that immovable property. What is the location of immovable property? Mumbai. So transfer the tenancy rate of a commercial complex located in Mumbai for a tenancy premium to Nexus Source Limited of Kanpur, Uttar Pradesh. They have given it to another person in Uttar Pradesh. So you will take Uttar Pradesh as the place of supply. Be careful. It is service in relation to immovable property. So therefore Mumbai should be taken and it will be taxable. So see this. Transfer of tenancy rights. Transfer of tenancy rate in the form of tenancy premium is taxable even though stamp duty and registration fee have been paid on the same. It is an intrastate supply since place of supply is location of immovable property. You understood? Location of immovable property. So intra, how sir? Only a student who learned the subject will be able to answer this. Otherwise, everyone what they will think, location of recipient, service, location of recipient is a place of supply, like that they will jump to conclusion. Okay. So service in relation to immovable property. So because any service in relation to immovable property, location of immovable property will be taken as a place of supply. And remember, sometimes if the property is outside India, then location of recipient, that point also will be tested here. Okay. But here it is intrastate, chargeable to CGST, SGST, and we don't have any RCM in this regard, it will be FCM only. And sir, they gave it as commercial complex, and for that RCM can't be invoked, sir. Supplier should be unregistered, recipient should be registered. Can't we take that? Because renting of commercial property is covered under RCM now. No, don't take that, because in this case it is not renting of commercial complex, it is transfer of tenancy, right? It is service in relation to immovable property, not renting of immovable property. That's why that RCM point we don't have to check here. Okay. So these are the outward supplies we finished, and in additional information did they give anything related to this? No. Over. So this statement total will be the total output tax. Then we need to check inward supplies. From inward supplies we will know it will come in statement 2 and statement 3. RCM means statement 2, ITC means statement 3. RCM means both statement 2 and statement 3. First one. Imported Bluetooth speakers from Korea, import of goods, and the goods landed in Mumbai port and reached at its registered premises on 30th April. Value for the purpose of levying IGST is 4 lakhs. Okay, means assessable value, basic customs duty, social welfare surcharge, everything included. So 4 lakhs will be taken. Okay, not that IGST is 4 lakhs. You have to read the question carefully. So because IGST is 4 lakhs like that only, your mind will tell IGST 4 lakhs like that. No, the value for the purpose of levying IGST is 4 lakhs. On that 4 lakhs we need to multiply 18%. Okay, and this IGST is paid under customs. So see here how it should be written. Import of Bluetooth speakers. This is a ICA question only. I think it's RTP question. This RTP question, I did not create it. I created some questions. My hand is there. Many questions I created, but this particular question is not mine. I think this is ICA question only, RTP question. Let me check this. All RTP questions are included, don't worry. You don't have to refer RTP separately. 1 point, yes. 1 point supply. It's an RTP, latest RTP question. Next. And that too they have made it using ChatGPT. You know how I'll tell you? Easily you can find. Usually ChatGPT will not understand the company names and they will not give gap. Build Pro like that. If you see like this, it's a ChatGPT. Okay. Because 1 point, usually what we do, 1 space point like that we will draft. So ChatGPT, all company names, it will not understand. So it will think the company names means name. Name will be together like that only it will think and it will give it like this. Okay. So Tool Mart, no doubt they have made it using ChatGPT, but of course humanization is lot they have made on the background. Then next one, invert supply. First you need to take import of Bluetooth speakers, IGST payable on import of Bluetooth speaker payable in cash through IC Gate portal while making customs clearance. Like that you should write. Where? Under which act? Under Customs Act we pay. Okay. 4 lakhs and IGST. Always import of goods is deemed interstate supply, IGST. Also it will come in ITC. On import of goods, whether IGST paid can be taken as credit? Yes. Input tax includes IGST charged on import of goods. So even we will put it in statement number 3. Then next invert supply you see. Participation fee paid for the business exhibition held in Germany organized by Dhwani Limited, Dhwani India Limited. So business exhibition, participation fee paid. What about this? Not a supplier. Yeah. First of all, supply or not a supply, why you check all those things? You have to see. If you tell exempted, I would have been happy. Not a supply is not happy. Okay. Exempted, agreed. But not a supply, how pa? It is import of services or service in India only. Participation fee paid for the business exhibition held in Germany organized by Dhwani India Limited. So supplier in India, organizer in India, and recipient is also in India. 1 point supply private limited in India. So you may get it out that Dhwani is in India or not. That's why they mention in the company name itself that it is India Limited like that. So organizer of business exhibition in India and the recipient is also in India. But we have an exemption. If the business exhibition is held outside India, then it is exempted. Correct? So first of all it is exempted. Means on this invert supply there is no GST at all. When there is no GST at all, there is no question of ITC. So that is this. Participation fee paid for business exhibition. No RCM. First it is exempted since service provided by organizer to any person in respect of business exhibition held outside India. See, usually you thought in outward supply they will give exemptions, but on inward supply they gave. Okay. So Aap is in laddu, not in bolt. You understood or not? So therefore we will think that it is in bolt, but it is in laddu. You got it? What I am telling. So you will think something, but there will be in some other thing. So therefore be prepared. Expect the unexpected, like Big Boss. Okay. So organizer to any person in respect of business exhibition held outside India. No GST is payable on the said services. Consequently, ITC is not available. It is actually exempted. Next. But what our people will do? Germany, Dhwani, import of service, chargeable to GST under RCM. No? Full. As per your wish you will do. So left, right, center like kaima, no. What is that? That shawarma. Like they will hit na. Like that question answer completely will miss and right. Then salary paid to employee on rolls. Salary. Not a supply. Now you should tell. Not a supply. Agreed. So, not a supply. Employer to employee in the course of employment is excluded from supply as per 7 subsection 2 Reddy schedule 3. hence GST not payable, consequently ITC not available in this case. Then next, consumables procured from registered suppliers located in Gujarat, including diesel. So excise and VAT paid, what, 75,000 for running machinery in the factory. What about this? You are procuring the consumables, excluding including diesel and VAT paid, what, 75,000 used for running the machinery in the factory. So can we take ITC on this? 1,50,000 minus 75,000 into what is the rate of GST? Did they give any other rate of GST? No. So therefore we will take 18%. And from where you are procuring it? From Gujarat. Where are you located? Maharashtra. So therefore it is interstate purchases. Correct? So interstate purchases, say this, 75,000, 1,50,000 minus 75,000. So 75,000 into 18%, 13,500. Okay. So why these two will be excluded? What non-taxable? See, including diesel, that is excise and VAT paid worth rupees 75,000 used for running the machinery. It's not about excise and VAT, it's about the diesel. Diesel is a non-taxable supply. First, on non-taxable supply there won't be any GST. Means on remaining consumables only there will be GST. That's what you need to write. So what is it you need to write? It is a non-taxable supply. Petroleum products. On petroleum products there is no GST. The question of ITC shall not arise. Okay. Whereas the remaining 75,000 procured from suppliers in Gujarat, therefore it is interstate supply IGST. What if they have given diesel procured, not diesel procured, some goods which are procured, and that includes excise duty, state excise duty and VAT, like that if they have given, then include in value. For payment of GST it should be included in value. You got it? Next. So we have got the ITC, and can we take ITC on the consumables? Yes, it is used in the course or furtherance of business and nowhere in the blocked credit. Definitely you can take ITC with respect to that. That's why it came in the ITC column. We completed first statement, second statement and third statement. Now the fourth statement, computation of net GST payable. Output tax liability. So we need to refer statement 1, 1,08,000, 1,08,000 and 1,08,000. 3 minus ITC. Now listen, what is your ITC? 85,500 rupees only, that to IGST. So your ITC is way less than your liability. So don't apply 86B. When you apply 86B, your ITC is equal to or more than or nearing to somewhere like gross liability, then you need to apply. So less input tax credit, refer statement 3, nil and 85,500. And net GST payable will be 1,08,000, 1,08,000 and IGST, because IGST credit should be first utilized for payment of IGST liability only now. Then this is shown as net GST liability. Even that RCM through IC gate is there na, that is also shown here. But they did not add and show. They just showed it as a breakup. Net GST payable under GST law. Then RCM liability also whatever is there. But this is how the answer is given in the RTP. So that's why I told you with so much confidence that on import, whatever IGST is paid should be part of the statement. But in some old questions, they have not done that. Only in the latest questions, they started doing it. And it's an RTP question, they did literally like this only. So therefore, you follow this methodology. Okay. Next. So question number 1, got the confidence, how to present it, etc. Now in the same way, you start practicing all the questions. So what you do, don't see the answer. Don't see the answer. Every comprehensive question that you come across, you start doing it. What you need to do, take a sheet and you do the working and you put it. Explanation notes and all you don't have to write. At least you put it where it should be coming, etc. and all. And then you cross check with the answer. You will learn what are the mistakes that you are doing. And definitely you will learn out of that mistake. And So you maintain one mistake ledger, that is a piece of paper or in the that's it book. At the end of that's it book some space will be there. There you write down mistake ledger. What is that mistake ledger? While solving the questions you make the mistakes na. Every mistake you write down there. What are all the mistakes that you have committed, that mistakes you write. So that will be helpful for you one day before the exam. Okay, these are all the mistakes. I should ensure that I should not repeat those mistakes. You got it? So like that you create a mistake ledger. Please follow this. Definitely it will be helpful for you, because before the exam you will not know what to read, what not to read, etc. and your mind will be completely blocked, because lot of resources will be there. So definitely these kind of small informations will definitely be helpful, and you start reading the theory from that's it book. Nothing will go in your mind, and you know you will become frustrated, because the DT exam impact is that much. So that's where you will get frustrated and all. So therefore at that time, so what you need to do is that just see all those things, and it will be helpful for you to exam to recollect those points. And moreover, that mistakes when you see na, the question you will remember what is a mistake that you did in that question, etc. Rather than solving 100 questions before the day of exam, those mistakes if you write down, so by seeing the mistakes you will remember what are all the questions that you have applied there. Immediately you will check also the solved workbook, so from where you have solved it. Then question number 2, consider the following independent scenarios in the financial year 25-26 and answer the question that follows. Case 1, supply of food in a cinema hall. Galaxy Cinemas, located in Hyderabad, runs a multiplex and also operates a food counter in the cinema premises. During the month of April 2025, the following sales were made. Cinema ticket sales 8 lakhs, standalone sale of food and beverages at the food counter 3 lakhs. So on cinema ticket 8 lakhs we will pay 18%, and sale of food and beverages 3 lakhs we will pay 5%. On the combo offers, ticket plus food package bundled together, means it is composite supply, not mixed supply, bundled together. Both are taxable, naturally bundled in ordinary course of business, and principal supply is what? Ticket. Therefore it will be coming under composite supply, and we need to take the rate of principal supply. What is the rate of principal supply? 18%. So accordingly you need to arrive at the liability. So in this case cinema tickets 8 lakhs 18%, standalone food and beverages 5%, but combo offer entire amount 2 lakhs will be taxable at the rate of 18%. So this will be the GST payable, because we have a CBIC circular which says that whenever there is entry to theatre and supply of food in the theatre which is provided as a combo along with the entry to multiplex theatre or cinema theatre, it should be treated as a composite supply and taxable at the rate applicable to entry to cinema theatre. Next, supply of electricity with renting of commercial space. Urban Spaces Realty, a commercial property management firm in Mumbai, rents out furnished office space to tenants. In April 2025, it raised the following invoices to a single tenant. Rent for the premises 1,50,000, maintenance charges 30,000, electricity charges billed separately 20,000, and Urban Spaces procures electricity from Maharashtra 20,000 and charges the same amount to tenant without any markup. Now tell me, what should be taken as the value of supply in this case? 1,80,000. So the 20,000 rupees will be included in the value or not included in the value? No, they will become pure agent. We saw that electricity charges which is paid by the property owner or association and in turn collected it from the tenant on actual basis, they are acting as a pure agent, and that will not be included. Whether it is billed same or billed separately, that doesn't make any difference. So we need to take 1,80,000. In that, so what is the rent? 18%. That rate only will be applicable even for maintenance charges. So electricity charges form part of composite supply unless charged as a pure agent. Okay, what if they make gain out of this? Included. And what rate will be taken? Sir, electricity is exempted na sir. Correct. But now the character of electricity is the character of maintenance charges or rent. See, your expenditure may be exempted, but when you recover that expenditure, the character of that expenditure is the character of your supply. So, which means your supply is maintenance service, means it will be maintenance service. If your supply is rent, means it will be rent. Keep that in mind, okay. Your expenditure may be exempted, but when you recover that expenses, that need not be exempted. What if you provide the electricity? I gave one question like that in test series, that the association only creating the solar panels and they supply the electricity as a utility, then exempted. That electricity will be exempted. You understood? And accordingly you need to change the answer. Be careful. So here what are the three possibilities I gave you? This is first possibility. Second possibility, if they make a markup, you add it into it and then you take the rate applicable to rent or maintenance charges as the case may be. Third one I told you, if they themselves is supplying the electricity, then only it will be exempted, okay. Then it will not be chargeable to GST. And sir, won't it become mixed supply and taxable at the highest rate? No, because in order to become mixed supply, it should be for a single price. So therefore, even though it is exempted, but don't tax it, because the mixed supply point is applicable if there is a single price. When we show the 20,000 separately, which is exempted, when it is exempted, if they are only supplying the electricity, then it is exempted. Next. So that is the answer for this. As per CBI circular, it is clarified that whenever electricity is being supplied, bundled with renting of immobile property and or maintenance, so it forms part of composite supply, shall be taxed. The principal supply is renting of immobile property and or maintenance of premise as the case may be, and the supply of electricity is ancillary, okay. Whereas if they are recovering it as a pure agent, then it will not be included. So since urban spaces charges exact electricity cost 20,000 without markup, they are acting as a pure agent. So that will not be included in value, and the value will be 27,000, like 1,50,000 and 30 on that 18%, 32,400. Understood, pa? These two are not tested. So that's the reason why they can make a question like this for 5 marks. Like this, usually 2 situations they will give for 5 marks. Then next, look into this. This is also a very good question. Measures Global Trade Solutions Private Limited, based in Guwahati, Assam, operates as an indenting agent. Measures Orient Textiles Limited, headquartered in Dubai, UAE, supplies yarns as per the instructions of Measures Global Trade Solutions Private Limited to buyer located in India. Okay. So see the transaction carefully. Orient Textiles Limited is Dubai based company and they are selling yarn to buyer located in India. But this transaction is through an agent. Where is that agent? Who is that agent? Global Trade Solutions Private Limited. And where is that agent located? In India. Okay, they are an intermediary. Whether this transaction is taxable or exempted? Exempted. An intermediary who is acting as an agent, getting a commission, exempted. When exempted? Okay, exempted, correct. You went up to there. When exempted? Very good. When both are outside India, seller of goods outside India, buyer of goods outside India, and I am an agent connecting them, then only my commission is exempted. But here is seller and buyer both are outside India. No, seller outside India, buyer in India, I am connecting them. So my intermediary service is not exempted. That will be taxable. Then continue. Measures Orient Textiles pays a commission to Global Trade Solutions Private Limited, Guwahati, at a predetermined percentage as a sales value. Measures Orient Textiles is a foreign entity with no permanent establishment in India. The commission is received in foreign exchange by Global Trade Solutions Private Limited. The commission receipt is not subject to any other tax liability in India. Answer the below questions. Is Global Trade Solutions Guwahati liable to pay IGST on the commission received? Yes. If your answer is yes, won't it become export of services? Won't it become export of services? You said first it is not covered under exemption. Super. Then it will be taxable. But see, service is taxable. But the payment of GST depends again on other factors also. What is the other factor? The service is taxable. Yeah, the service is taxable, no doubt. But the payment of GST depends on other aspects. What are the other aspects that we need to see? Won't it become export of service? Because if it is export of service, we can export it without payment of IGST, na? Will it become export of service? Yes, sir. Place of supply is India because it's an intermediary service. Section 13, RBI, I for intermediary. Section 13, location of supplier will be taken as the place of supply. Here, what is the location of supplier? India, Guwahati, Assam. Therefore, it will not become export of services. In order to qualify as export of service, supplier should be in India, recipient should be outside India, place of supply should be outside India. But in this case, place of supply is in India. So, it will not become export of service. Consequently, GST is payable. You got it? Now, CGST, SGST, IGST. Why IGST? Why IGST? Sir, supplier Guwahati, Assam, sir. Place of supply also Guwahati, Assam, sir. It is intrastate, na, sir. The moment you determine the place of supply under section 13, it will be deemed interstate supply even though it is in India. It will become deemed interstate supply chargeable to IGST. See in one question how many points, okay. So, place of supply, location of supplier Guwahati, Assam, and as per section 13.8 because it is intermediary services and supplier is in Assam. Since one of the condition of IGST, place of supply should be outside India is not satisfied, the commission received does not qualify as export of services. Therefore, in this case, IGST is payable. IGST applicable since the place of supply is within India but the recipient is outside India. 75C. 75C. What is that? Place of supply, that is supply in India, not elsewhere specified. That is 75C. That is deemed interstate supply will come. The moment you determine place of supply under section 13. If you have doubt now while discussing, you need to check that SIT book. At least that way it will go in your mind. Okay. Don't look into me or don't look into the answer alone. Search for that SIT book also. 75C like that I have given. 75A, 75B, 75C. 75C, it will be coming in that chart. Okay. Next. Second one. If yes, how is IGST calculated if US dollar 1,20,000 is received in April? Okay. So they are receiving money and how that will be calculated in GST? You have to convert the foreign exchange. Whether they need to pay IGST? Yes, just now we saw that they need to pay IGST. But they need to pay IGST in Indian rupees. But the dollars they are receiving, how to convert? Rule 34. Rule 34 of CGST rule says that whenever the transaction is denominated in foreign currency, it is a service. So we need to take the GAAP rate, not CBIC rate. So they have given exchange rate as per GAAP 75.5 and as per RBI 75. But which should be taken? 75.5 and the rate is 18%. So say this. Exchange rate GAP 75.5, so into 1,20,000, 90,60,000, on that IGST 18%. So we are applying rule 34. We are applying rule 34 here. Okay. Then next, third. Almost 10 provisions we would have applied in this. Whether the IGST paid on commission is eligible for ITC. Yes, because this is GST paid under RCM or FCM. It is GST paid under RCM or FCM. Whether IGST paid on commission is eligible for ITC, like that they are asking. Sir, it is your liability, sir. How you will take ITC with respect to that? Okay. It is a forward charge liability. It is not your RCM liability. How you can take ITC? Your recipient will take ITC. But where that idiot is located? Outside India. How he will take ITC? He cannot take ITC, na? So since Global Trade Solutions is paying IGST as a forward charge, not under reverse charge, it is not eligible to avail ITC on IGST paid on commission received. Also, as the recipient is outside India, they cannot avail ITC on the same. Then 4. If aggregate turnover of measure Global Trade Solution Private Limited during the preceding year is 550 crores, whether e-invoice or dynamic QR code in invoice is applicable. Which one? Neither e-invoice nor dynamic QR code. E-invoice not applicable because it is not an export of service and the recipient is not registered. Correct? turnover may cross 5 crores but it should be export of service, or at least the recipient should be registered. The recipient is not registered because outside India, and it is not an export of service, so e-invoice not applicable. Dynamic QR code not applicable. If you remember one circular we saw that if the recipient is outside India, we don't have the UPI system, so dynamic QR code is not applicable in that case. E-invoice not applicable in the given case, as the same is not an export of service or the recipient is not registered. Also dynamic QR code invoice is not applicable as the recipient is outside India. But this is my creation only for this question. Okay. Then see the fifth one. What is the treatment of commission earned by Global Trade Solutions Private Limited if Orient Textiles is making sales to buyers in Sri Lanka? Then it is exempted, because intermediary service where supplier of goods and recipient of goods outside India. Then as per section 11 Reddy notification 12/2017, services by an intermediary to a person in non-taxable territory supplying goods to a person in non-taxable territory is exempted. As supplier is outside India and buyer is also outside India, commission earned by them is exempted. Okay. Next. Question number 4. Skyway Travel Solutions Private Limited, an air travel agency, needs to determine its GST liability for the quarter ended June 30 based on the following details. Basic airfare collected for domestic ticket bookings 60 lakhs. Basic airfare for international ticket bookings 95 lakhs. Commission received from airlines on domestic and international ticket sales 5 lakh 20. Year-end bonus received from airlines 75,000. Compute the GST liability of Skyway Travel Solutions Private Limited for the quarter ended June 30. Additionally, determine whether the GST liability would be reduced if the company opts for the special provision for GST payment under Rule 32 Sub Rule 3. The applicable rate of GST is 18%. First, what is their normal liability? Transaction value. What is the transaction value? Their agency when they sell ticket, they are not required to pay. The airline should pay. But what is the transaction value in their hands? 5 lakh 20 and 75,000. That year-end bonus received also should be taken. Yes, that is also part and parcel of their consideration, and towards the commission it will be taken. So 5 lakh 20 plus 75,000, that is 5 lakh 95,000. On that 18%, 1 lakh 7,100. If they go for Rule 32 Sub Rule 3, air travel agent has a special option where they will take 5% of base fare in case of domestic bookings, 10% of base fare in case of international bookings as the value. That is 60 lakhs into 5%, that will be 3 lakhs, and 95 lakhs into 10%, 9 lakh 50, 3 lakhs and 9 lakh 50, 12 lakh 50. On that 18%, that will be 2 lakh 25,000. So what is your answer? It is advisable to pay GST under transaction value. Can they choose like this? Yes. Option 1 selected beginning of the financial year will applicable throughout the financial year. True or false? False. It is not that. For each invoice they can choose. Each month and each invoice they can choose. So since the GST liability is higher under Rule 32 Sub Rule 2, Skyway Travel Solutions should continue with the transaction value for GST payment to maximize the tax liability, as it is at the option of the supplier to adopt the value under Rule 32. Correct? It is at their option. Either they can go for Rule 32 or they can go for transaction value. Okay. Sorry, minimize the tax liability, as it is at the option of the supplier to adopt the value. Doubt appa? You understood now this one? You would not have solved this question. You would have solved only Rule 32 Sub Rule 2, but this comparison even ICAI not tested so far. So they can just check this. Okay. And it is at the option for them to decide with respect to each transaction. Next question. Question number 5. This also they have not asked in exam so far, but probable question. Messrs. GK Developers Limited, hereinafter referred to as the developer, entered into a JDA, Joint Development Agreement, with Mr. Nagarajan, the landowner, on 31st May 2024, wherein transferable development rights in respect of a plot of land were granted to the developer. However, the ownership of the land remained with Mr. Nagarajan, that is only license to occupy the land was granted, so it is not excluded from supply. It is not a sale of land, but it will be transferable development rights, which will be services, it is covered under RCM. TDR, FSI, long-term lease to builder is covered under RCM. Subsequently, a supplementary agreement, conveyance deed, was executed on 15th June, where 10 residential units and 2 commercial units were to be constructed by the developer, out of which 4 units will be allotted to the landowner. So, for the landowner, what is the consideration? That 4 units is the consideration, and therefore in the hands of the landowner, GST not payable. So, the promoter or builder will pay GST under RCM. Correct? Next, continue. So, this is inward supply of TDR FSI long-term lease on which builder will pay GST under RCM. Next, all residential units pertain to non-affordable residential housing and no booking were made before the issuance of completion certificate. Why like that it is given? I'll tell you the twist. Wait, I'll tell you why this line is given. Answer the following. Is the transfer of development rights a taxable supply under GST? If yes, who is liable to pay GST and what is the time of supply? First, TDR is not sale of land. It is not excluded from supply. It is right to use the land. So, it will be covered under RCM as per section 9(3) read with notification 13 of 2017. However, the regular time of supply provision is not applicable in this case because there is an exemption available with respect to inward supply of TDR FSI long-term lease. There is a proportionate to residential units booked before completion certificate divided by total carpet area, like that one exemption is there. So, the time of supply will be the completion certificate date or first occupation date, whichever is earlier. So, in this case, what is the time of supply? Completion certificate date or first occupation date, whichever is earlier. See the answer. Yes, the transfer of development rights by Nagarajan in favor of the developer is a taxable supply of service. As per notification 13 of 2017, GST on TDR is payable by the developer under RCM. If the developer is not paying GST on construction service for the units transferred to the landowner, and time of supply as per notification 6 2019, the time of supply for TDR shall be date of completion certificate or first occupation, whichever is earlier. So, in case of the TDR, this line is given in study material, but in one small line somewhere it is given. Okay. So, I thought like that only they will ask questions. So, I took that and I made. Okay. Then next, B. Is the GST payable on residential flats allotted to the landowner under joint development agreement? If yes, what is the time of supply? Now see the twist from the builder point of view. Builder is giving the units, flats, sale of flats. What is your answer? In the hands of builder, whether they need to pay GST on the flats which are given to the landowner. 4 flats given to the landowner. Is it covered under supply or excluded from supply? Covered under supply or excluded from supply? Is a consideration after obtaining completion certificate or before obtaining completion certificate? Before obtaining. What after? Podalanga after. Before, because today itself I am giving, like, see, you are the builder. What is the consideration you got? TDR. When you got TDR, way ahead, before starting foundation itself you got it. Before starting construction itself you got the TDR. Yeah? TDR is a consideration for you. Barter. In barter, for landowner, the flats is a consideration. Whereas for the builder, TDR is a consideration. You got it. So, he is getting the consideration when? Before obtaining completion certificate or first occupation. So, it is covered under supply and GST will be payable on these flats. Okay. Say this. Yes, transfer of constructed flats by the developer to landowner in exchange for TDR is considered a taxable supply of construction service under GST. Since the flats are handed over before issuance of completion certificate, consideration is in the form of TDR, means a consideration is received before obtaining completion certificate. Correct? They agreed na yaar, I construct the flats, 4 units I will give you, like that. Completion certificate is not obtained. Before that itself they have got the consideration, and therefore as entire consideration, why it is not excluded from supply? As entire consideration is not received after obtaining completion certificate, the time of supply will be same, completion certificate or first occupation, whichever is earlier. Okay. So, I connected even supply chapter, basics, that is consideration, barter and completion certificate point. So therefore GST will be payable. You will never get a standalone question. All questions will be like this. So connecting one to the another. Then see, what is the GST implication and time of supply for the flat sold by the developer to independent buyer after the completion certificate? Not a supply. This is not a supply. Why? Because all residential units pertain to non-affordable and no bookings were made before issuance of completion certificate. Means everything is sold after completion certificate. Therefore, it is excluded from supply. Except that 4 which is allotted, all others which are to independent buyers is after completion certificate, which is excluded from supply as per 7 subsection 2 read with schedule 3. Schedule 3 Schedule 3. As per Schedule 3 of CGST Act, sale of building where entire consideration received after obtaining completion certificate. Schedule 3. So while typing I mistyped it to Schedule 2, it is Schedule T, Schedule 3, 7 subsection 2 read with Schedule 3 of CGST Act, sale of building where entire consideration is received after obtaining completion certificate of first occupation whichever is early is excluded from supply. Therefore, GST not payable on sale of flats to independent buyers. Now last twist. Compute the GST payable by GK developers on the inward supply of TDR if the value of flats allotted to Mr. Nagarajan is 200 lakhs. That 4 flats allotted na, its value is 200 lakhs and applicable rate of GST is 18%. Tell me, don't see the answer. 200 lakhs into 18%, that is 36 lakhs. Minus exemption for 4 flats. Why? Proportionate of the residential units booked before completion. That 4 flats was booked before completion certificate. Nothing was booked before completion certificate is to outsiders. But that 4 flats was given before completion certificate only na. Means that got booked. Means proportionate to that 4 flats, the inward supply will be exempted. So how to calculate? 36 lakhs into 4 by 12. Because total 10 plus 2, 12. So 4 divided by 12 means to the extent of 12 lakhs it is exempted. Say this. Value of inward supply of TDR equals to value of units allotted to the landowner 200 lakhs. GST payable 200 lakhs into 18%, 36 lakhs. As per 11 read with notification, exemption with respect to residential units sold before completion certificate or first occupation whichever is earlier, and units allotted to landowner are considered to be sold before completion certificate and exemption available with respect to the same. So 36 lakhs into 4 by 12. So net GST payable by GK developers on inward supply is 24 lakhs. Next question. Again this question, no, you would not have done this. Okay. But tell me, pa, all these things you did, pa? No. Okay. Then. No, this exemption is not available if everything is commercial units. The exemption is only for proportionate exemption to residential units which got booked or sold before obtaining completion certificate. Then question number 6. Messrs. Glamour Cosmetics Private Limited manufactures 4 variants of nail enamel, namely blush, gloss, lux, shine. The company has availed ITC of 3,60,000 on common inputs used in the production of these variants. So they have got some common ITC. How much is the common ITC? 3,60,000. This is related to Rule 42 but in a different context. Then a portion of these inputs is also used for non-business purpose. That is given, which means D2 will be there. D1 also will be there. D2 will be there. What is D2? Common credit into 5%. During the financial year, the company manufactured 1,200 liters of each variant of nail enamel. However, the company has not maintained a separate record of input usage of each final product. GST is payable on final products at the rate of 12%. You are required to calculate the net GST payable by Glamour Cosmetics Private Limited for the financial year based on the following information. Wherever applicable, they are making 0 rated supplies without payment of GST under bond or LUT Assume all supplies as interstate supplies. So we have 4 products and sale to domestic tariff area. Blush is sold to DTA, normal taxable. So therefore chargeable to GST. So what is the value? First, blush sale to DTA, sale price per 200 ml bottle is 36 rupees. But how many liters they are making? 1200 liters of each variant. 1200 liters of each variant, which means 1200 liters. 1 liter will be how much ml? 1000 ml. That is what you should know. Okay. So 1200 into 1000 divided by 20 ml means how many bottles? 1200 into 1000 divided by 20. How many bottles? 60,000 bottles. Each bottle will be 36 rupees. Each bottle will be 36 rupees. 21,60,000 is the value. On that the rate of GST will be 12%. That is 2,59,200. Okay, wow. And for payment of GST what it is? Taxable. So for ITC purpose also it will be taxable. Okay. We are analyzing the meaning of exempted supplies for ITC purpose. Okay. You should prepare a table like this only. Then second, gloss sold to SEZ. Sold to SEZ is what? Zero rated. Zero rated. So therefore for payment of GST, zero rated without payment of GST, because under bond or LUT, assume that they are making zero rated supplies without payment of GST under bond or LUT. So no GST. But for ITC it will be treated as taxable. So see the value, same 1200 into 1000 divided by 20 into 48, 28,80,000. No GST, it will be zero rated supply, but for ITC purpose it will be treated as taxable. Then export to Elan Incorporation, Canada. So that is zero rated again, no GST. What is the value? Value you should ascertain. So that is 1200 liters into 1000 divided by 20 into 60. How much? 36 lakhs. Is it zero rated supply? Yes, but for ITC it will be treated as taxable. Sold to Armed Forces Canteen, GST exempted, 72 rupees. Now exempted supplies. So value is how much? Same way, 1200 into 1000 divided by 20 into 72, that is 43,20,000, and you don't have to pay GST exempted. As it is exempted for payment of GST, it will be exempted for ITC purpose also. Now total turnover you got and total GST payable you got, and 1200 liters is this ml 60,000 bottles. How it is computed is given. Now reversal of ITC. First liability we computed. Now second reversal of ITC. What is the total ITC? Common ITC 3,60,000. But this common ITC is used for all the 4 products. But there is one product which is exempted, which means exempted to total we need to reverse the ITC. What is the exempted outward supply? 43,20,000. What is the total outward supply? 129,60,000. So 36 lakhs into 43,20,000 divided by 129,60,000, 1,20,000 is a common credit attributable to exempted supply. And also it is given in the question that they are using it for non-business purpose as well. So common credit attributable to non-business purpose will be 5%, that is 18,000. So total ITC reverse will be 1,38,000. What is the net eligible ITC? Out of 3,60,000, if you take out 1,80,000, 2,22,000 is the net eligible ITC. Now, should we check rule 86B? Turnover exceeds 50 lakhs, taxable turnover exceeds 50 lakhs or not? No. No. While doing rule 86B turnover, you should not take zero rated turnover. You should take only taxable turnover. So 21,60,000. Is it clear? You should not take zero rated turnover. You should not take exempted turnover. You should take only taxable turnover. So 86B is not applicable. Okay. Moreover, one more reason, even if that is more than 50 lakhs, even if it is more than 50 lakhs, but the ITC is less than the liability. So therefore 86B not applicable. Any reason you can write. So 86B not applicable as a balance in ITC less than tax liability, or you can also write this reason. What is that? Taxable turnover taxable turnover less than or equals to 50 lakhs. Less than or equals to 50 lakhs. So fully you can use the ITC for payment of the liability. Net GST payable will be 37,200. Got it? So they may not ask rule 42 in 14 marks question, but they can create a 5 mark question also on rule 42 like this. It's a 5 mark question possible. Then next, question number 7. Zenith Chemical and Allied Limited is diversified Indian conglomerate dealing in specialty chemicals, industrial reagents and allied services. This is your RTP question, JAN'26 RTP question. So latest, definitely this attempt I told you there will be a question on ISD. Who knows, the same question also they can copy paste. Over the years, it has established production, trading and services units across multiple states. It has obtained separate ISD registration in the state of Kerala. The ISD receives invoices for services used across the group and distributes the ITC pertaining to these invoices to various units. Following details are furnished for a particular month. You are required to distribute the ITC to other units that are carrying manufacturing, trading and supplying services to the customers. Where is the ISD located? Kerala. Where is the ISD located? Kerala. And turnover in the relevant month of each of the units is given. Mumbai, Bengaluru, Hyderabad, Trivandrum. That data is given. Total ITC of input service available during the month with ISD includes CGST, SGST and IGST on account of supplies received during the month. How much? 48 lakhs. Total ITC of input services. So how this 48 lakhs will be distributed? Is it common? Is it common? Yes, it is common. Nowhere it is given specific for one particular unit. Correct? Nowhere it is given that it is specific for one unit, but they gave all other data, and also all above amounts are exclusive of GST. Make your comments regarding the ITC, and you take this 48 lakhs, divide it between all these three in what ratio? Turnover ratio. Oh, we have some other date also. Wait, we will read that. Out of the above, okay, total is 48. Out of the above, ITC of input service exclusive to Bengaluru unit 12. It will be given fully to Bengaluru unit, and Bengaluru unit is in same state or different state? Different state. So it will be IGST. Correct? So in preparation of table itself, what you need to do, within the state you need to take CGST, SGST, IGST, but all other states you need to take as IGST. So Mumbai unit, Bengaluru unit, Hyderabad unit, IGST, 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 Trivandrum unit, CGST, SGST, IGST. So ITC exclusive for Bengaluru unit, we will be giving it to Bengaluru unit. Next. Out of the above, ITC of input service exclusively to Trivandrum and Hyderabad units, CGST, SGST 3 lakh each. Now, first 6 lakhs you take. What is the turnover of Hyderabad? 36 divided by total of these two, 36 plus 72, 108. So as it is attributable to two units, you need to distribute between those two units only. So 6 into 36 by 108, 2, that will be given to Hyderabad unit. But with respect to CGST, SGST, you need to follow the same. So for Trivandrum, so now you take 3 into 72 by 108. 3 into 72 by 108. How much? 2. So that will be given to CGST, SGST for Trivandrum. That 6 total we can give it to Hyderabad because it is IGST. So we are taking 6 into Hyderabad turnover divided by total turnover. Whereas Trivandrum turnover, CGST, SGST, we are taking separately and checking what is their turnover divided by 108. Is it clear? Sir, usually we need to take previous year turnover na sir. Previous year or previous quarter. No, we can take monthly turnover also, because now we have got the updated rule. which says that monthly turnover also can be taken with respect to the units. Okay. So therefore this monthly turnover can be taken for distribution. Then next, rest of the credit of input service available is allocable as common credit to all units and is received from local suppliers in Kerala. Okay. So what is the remaining credit? 48 minus 12 minus 6. What is the remaining credit? 30. What you need to do with respect to that 30? Listen, 30 into, it's a common. So for all, into 12 divided by total. What is the total of this? 180. 12 divided by 180. 30 into 12 by 180. 30 into 12 by 180. How much? 2. Okay. Next. 30 into 60 by 180. 10. Done. 30 into 36 divided by 108. 6. Okay, wow. Now listen. Now you don't distribute like this. You divide. So what is this 30? 15, 15. Now you take 15 because Trivandrum. For Trivandrum, you will distribute CGST as CGST, SGST as SGST because it is common credit received from local suppliers in Kerala. So due to that reason, you take 15. 15 into 72 by 180. 15 into 72 by 180. 6 and 6. Or sir, you can take total divided by 2 also you can do. That is also fine. You can take total divided by 2 also you can do. That also you can do. But I am just telling you the process of putting it into the table. Next. Basic value of a debit note received for input services during the month. Can we take ITC in respect of a previous supply with tax levied at 12% IGST being charged and shown separately? This pertains to all 4 units of the company. So whenever we receive a debit note, on the basis of debit note also we can take the credit and distribute the credit. What is a debit note? 50 and distributed to all the units. Correct? So basic value of the debit note. So 50 into 12%. This month only you receive debit note. This month only you receive debit note. What if it is debit note of earlier month? You cannot distribute it now. But debit note we received this month only, that can be distributed. Okay. But the debit note pertains to some invoices of earlier period. That's fine. But the debit note is this month only. So we can definitely take the credit and distribute. So 50 into 12%. How much pa? 6 6 into 12 by 180. 6 into 12 by 180. 0.4 So 0.4, this 0.2, 1.2. But Trivandrum don't bifurcate because it is IGST. So put it under IGST column. So therefore 6 into 12 by 180, 60 by 180, 36 by 180, 72 by 180. We will put it. All this is calculator job. You don't have to use your brain. Whenever you get a question on ISD, just time waste only. Okay, time waste only. It will take time. But your calculator will do all these things. Then next. But good. At least one question guaranteed we will get marks. No. Then thereafter. Total value in the credit note received. Credit note when we receive, ITC will be reduced. So whether the ISD has to distribute that credit note impact also? Yes. Yes, I told you. Credit note impact also now they need to distribute. Total value in the credit note received for the input service during the month, applicable exclusively to Trivandrum unit, taxed at the rate of 9% CGST, 9% SGST, which is charged and indicated separately. So 118 into 18 by 118, that will be 18. So 9 rupees and 9 rupees, correct? So see this. Credit note, they are reducing it for Trivandrum unit. And any other answer? No. Any other point? No. Total 2.4, 2.4, 9.2, minus 1 and 2.4. What is the, why minus 1? Because the distributed credit and the credit note impact, if you see it is minus. So then what will be the situation here? You distribute like this 1 and 1 will be added to the liability of Trivandrum unit. Sir, ITC balance, there is not much. So credit note issued means they need to reverse the ITC. If they don't have sufficient balance in ITC, what they need to? They need to add it to the liability. So this 1 and 1 will be added to liability. This 2.4 they can take ITC. You got it? In turn, that 2.4 they can utilize it for payment of this 1 and 1 liability. Yes, they can. Negative amount apportioned to Trivandrum unit shall be added to the output tax liability since ITC distributed to it by ISD is less than the amount reduced on account of receipt of credit note. Clear? So this is a question given in RTP. So I somehow feel like they will be asking because all these are new points. This debit note, then monthly turnover and credit note distribution, even negative balance it is okay, that should be added to liability. These are all some new points which was not there in the previous. Then look into question number 8. This question number 8 also will take your mind. Measures Brighton Engineers Karnataka had its GST registration cancelled with effect from 31st December 2024 due to non-filing of returns, cancellation of registration. Later, revocation of cancellation was granted on 31st May 2025. During the period, the following transactions occurred under RCM. Security agency service received from Beast and Company, registered person, RCM is applicable. Service completed on 10th January, invoice received 15 January, invoice value 1 lakh, GST 18%, full amount paid to supplier 15 January. Now, first, we need to take the time of supply. We need to take the time of supply for this. What is the time of supply for this transaction? Date of payment or 61st day from the date of invoice, whichever is earlier. Services, RCM, section 13(3). Invoice is given by the supplier. Date on which payment is made to supplier or 61st day from the date of invoice, whichever is earlier. What is the date of invoice? Date of payment to supplier, 15 January. Or 61st day from the date of invoice. Invoice also 15 January, you count 61st day from there. Later, whichever is earlier will be 15 January only, correct? 15 January is the time of supply. So see this, security agency service, Beast and Company, it is covered under RCM. Why it is covered under RCM? Security agency service to a registered person is covered under RCM. And invoice date is 15/1/2025, it pertains to financial year 24-25 and GST is 18,000. Where is it given? It is given that 1 lakh into 18%, 18,000. Time of supply will be date of payment or 61st day from the date of invoice, whichever is earlier, 15/1/2025. Okay. Now ITC. We need to check the ITC. They have given one point that they have for all the above services GST paid to department through cash ledger on 30th June. ITC has not been availed for all the supplies till 31st May 2025. Till 31st May 2025 means their registration was cancelled from 31st December 2024 to 31st May 2025. So they have not taken ITC. Now first thing you need to check, is this invoice pertaining to the date before the date of cancellation? Check the question. Is this invoice, please check the question properly and tell me, is this invoice pertaining to the date before the date of cancellation? No, it is during the period of cancellation. Definitely we cannot take ITC. So what is the time limit by which we need to take ITC? So after revocation within 30 days or the maximum time limit. So what is the minimum time limit? 30 days from 31st May. See there. Invoice pertains to cancellation period. We don't have to check anything. Happily we can take ITC. Minimum time limit for availment of ITC is 31/5 plus 30 days, 36. Maximum time limit for availment of ITC is 30/11. Definitely we can take the ITC. Is it clear? Next, second transaction. Second transaction, goods transportation service from an unregistered transporter, RCM applicable. Invoice date, self invoice issued by the recipient 28 December, invoice value 50,000, GST rate 5%, full amount paid to the supplier on 8th December 2024. Time of supply you tell me. Date of payment to supplier 8th December, date of invoice to supplier because it is self invoice, that is 28 December, whichever is earlier, that is 8th December. See here, goods transport unregistered GTA 2812 is the date of invoice. So financial year 24-25, GST 5%. So therefore it is 50,000 into 5%, 2,500. Time of supply, date of payment to supplier 812, self invoice to supplier 2812, whichever is earlier will be 812. If 812 is the time of supply, then this date of invoice is 2812. Is it pertaining to the date before the date of cancellation? Yes. And what is the time limit for availment of ITC? Regular time limit. What is the regular time limit for availment of ITC? 30th November. In all the cases, they are filing the annual return by 31st December of the succeeding financial year. Means what is the regular time limit? 30th November 2025. Now tell me, for this invoice, whether the time limit to avail ITC expired or not expired? Not expired. As on the date of cancellation, it is not expired. Correct? Now, what is the time limit by which ITC can be availed? Same. 30 days from revocation order or the regular time limit, whichever is later. Correct? So, what is the minimum time limit? 31/5/2025 plus 30 days. Maximum time limit will be 30/11/2025. Okay, wow. Next, third, import of services, RCM applicable, invoice dated, self invoice issued by recipient 1st August 2023, invoice value 2 lakhs, GST rate 18%, full amount paid to supplier 8th August 2023. Now what we need to do in this case? 1st August should be taken, correct? 1st August should be taken as the time of supply. How 1st August will be taken as the time of supply? So date on which payment is made to supplier 8th August or date of invoice, self invoice to supplier 1st August, whichever is earlier. So say this, 1/8 is the date of invoice. So financial year 23-24, 36,000, date of payment to supplier 8/8/2023, self invoice to supplier 1/8/2023, time of supply 1/8/2023. Now, is this invoice before the date of cancellation? Yes. What is the regular time limit for availment of ITC for this invoice? 1/8/2023, financial year 23-24, 30th November 2024. Correct? 30th November 2024. But your registration cancelled on which date? 31st December 24. Means as on the date of cancellation, the time limit avail ITC is expired. So therefore, we cannot avail the ITC. Sir, the time limit under 16(6) is not applicable. 30 days from revocation order, regular time limit whichever is later. No. Invoice before the date of cancellation and the regular time limit for availment of ITC is 30/11, which is before the date of cancellation, and ITC not available in this case as the regular time limit for availment of ITC is expired as on the cancellation date. You got it? So ITC not available? No. How much is the total ITC available? 18,000 and 2,500. That will be 20,500. Good question, no? But the question did not stop yet. Wait. Compute the GST payable and interest at the rate of 18% per annum if any. Why? Because all these three invoices, they are paying the GST on 30th June 2025. That's why we discussed time of supply. So the time of supply is 15/1, then the due date is 20th February 2025. Correct? Second transaction, time of supply is 8/12, so 20th January 2025 is the due date. Third transaction, 1/8/2023, so 20th September 2023. But all these three transactions, they are paying GST by 36. So interest will be payable. Got it? And that interest will definitely be payable because it is all arrears of tax only. So don't check anything. And moreover, GST under RCM we have to pay using cash ledger only. So we need to pay interest. How much is the interest? 18,000 into this period, 130 days. Then again this period, 161 days. Last case you see the twist. 29/2023 to 36/2025 for 649 days. But remember, in between leap year comes. That's the reason why divided by 366. First two cases it will be 365. So whenever in numerator you are taking February 29, in denominator we need to take 366. Okay. So this is the question, and this question is based on that 16.4 and 16.6 time limit for availment of ITC. Okay, so definitely this attempt expect a question on time limit for availment of ITC under revocation of registration. Okay, maybe not this much serious, this much difficult, little bit easy question will be there. Okay, so maybe see, you always should prepare for the difficult situation. When going gets tough, tough gets going. And none of my students who failed also told me that sir, I failed because of you. They did not tell, except for frustration, one or two people, but they did not, because they know that, you know, definitely the efforts what I am putting is high, they are putting is also high, beyond something, maybe it is the universe or past karma, etc. and all is playing because of that. Okay, so always we need to put our effort. When our effort is good, result will automatically come what may, maybe one or two attempts, but if everything favors, it will be somewhere we might have made some mistake. So not entire 100% is ICI. Let's divide 50-50. So we would have also done some mistake. That mistake you need to analyze. Maybe we would have taken it for granted, or sitting in the exam hall, we might not be able to recollect, or the pressure. There are many aspects. I am not telling this is like, you know, always because of your mistake in the sense, like you are taking it for granted alone. There are other factors. Pressure. The pressure cannot be withstand. There are a lot of people, so in the pressure they behave very odd. So it is not in their control. Sometimes in the exam you cannot vent out that pressure. So what you need to do is that you need to relax yourself. If you are not able to relax yourself, you will feel the pressure. When you are pressure, your mind will not work. It will be blocked. Please stop reading at 11 o'clock on the exam day. Don't take your book till the exam like that. Don't do all those things. Don't do those nasty things. In the 2 hours, what you are going to pluck? Nothing. Got it? 11 o'clock we will stop. So be relaxed. 11 to 12, 12 to 1, 1 to 1:45. So 2.5 hours. Be relaxed. 1:30 you need to go there. Don't listen, don't look at anyone. Just close your eyes. Somewhere you sit in the exam hall in one corner and don't speak to anyone. Don't look at anyone, because people will do all those overaction and all. Remaining days and all they will not do. Exactly exam day they will come and read. That exam hall outside they will read. 1:45 means 1:40. Hit this point, that point, like that they will read. Don't do. Be relaxed. Close your mind. Close your eyes and happily go for the exam. 1:30. Take the paper and automatically everything will come to you, because your efforts will not go waste. You are not karna to forget what you have learned in the battlefield. Yeah. So you are not having that curse and all. You will remember. Just believe in yourself. That is sufficient. Okay. Then see this question number 9. Messrs. Auto Drive Dealers Private Limited engaged in sale of passenger motor vehicles. Seating capacity does not exceed 13. Undertakes the following transaction related to demo vehicles for providing test drive to potential customers. I gave multiple scenarios because question can be asked in any scenario. Scenario A, in April 2024, the company purchased a demo vehicle for 10 lakhs excluding GST. GST charged 1 lakh 18%. The vehicle is not capitalized in the books and used exclusively for promoting sales of similar vehicles. Now, first, they can take ITC. Yes, they can take ITC because even though they have not capitalized, but as per CBIC circular, they can definitely take ITC with respect to any goods, that is any motor vehicle which is demo vehicle, provided it is used in the furtherance of business, the furtherance of supply. So therefore it is exclusive for promoting sales of similar vehicles. We can take ITC. Are we selling it? No, we are not selling it. So there is no question of liability on sale. Got it? Second scenario. In May 2024, the company purchases another demo vehicle for rupees 12 lakh excluding GST. GST charged 2 lakh 16,000. The vehicle is capitalized, but no depreciation is claimed on the GST component under the Income Tax Act. The vehicle is sold after 2 years for 8 lakhs. Can they take ITC? Yes. and no depreciation is claimed on GST component. First, as per circular as well as per 16.3, there is no restriction, they can take ITC. Number 2, what is ITC? 2,16,000, and next they are selling after 2 years. They need to pay GST as per 18.6 or section 15. 18.6, because they have purchased capital goods on which ITC is availed. 18.6 says ITC availed minus 5% for every quarter or part thereof. What is the ITC availed? 2,16,000 minus 5% for quarter. So how many quarters? 8 quarters. 8 into 5, 40%. You take out 40%. 2,16,000 minus 40%. 2,16,000 minus 40%. 1,29,600, or GST on sale value. What is the sale value? 8 lakhs. 8 lakhs into 18%. 1,44,000, whichever is higher, 1,44,000. See the answer. First case, there is no issue. ITC is available. First case, ITC is allowed because of the CBIC circular, and they are not selling it. So the question of GST does not arise. Second case also ITC allowed because they did not calculate depreciation on GST component, and when they are selling 18.6 will be applicable. 1,29,600 or 1,44,000, whichever is higher, 1,44,000. Third scenario, in June 2024, see, they can give 4 motor vehicles like different combinations also like this. Motor vehicle A, B, C, D, like that they can give. So June 2024, the company purchased a demo vehicle for 15 lakhs excluding GST. GST charged is 2,70,000 into 18%. The vehicle is capitalized and depreciation is claimed on the GST component. ITC not available. As ITC not available, when they are selling it, so it will be definitely section 15 only. Correct? Section 15. Why not 18.6? 18.6 will be applicable if ITC is availed on capital goods. So therefore, first of all, ITC not allowed in this case because capitalized including the GST component, and upon sale only section 15 is applicable because ITC not availed. So sale value into GST 1,08,000. What if they give WDV in this case? In this case scenario 3, what if they gave WDV of the asset because they capitalized? What if they give WDV as per Income Tax Act? Notification 8/2018 will come. Sale price minus WDV, margin scheme we can go. Got it? Next, scenario D. In July 2024, the company does not capitalize another demo vehicle and purchase for 9 lakhs and GST charge 1,62,000. They sold after 1 year. They did not capitalize. Can they take ITC? Yes. Capitalization is not a condition. They can definitely take ITC with respect to this. But when they are selling, 18.6 will not come. Why 18.6 will not come? Because they have not capitalized it. ITC available, but it is not capital goods. So therefore, we need to pay GST as per section 15, sale value into GST rate. Okay. And here if they give WDV, in scenario 4, if they give WDV, margin scheme not applicable because they availed ITC. Margin scheme not available because they availed ITC. If you avail ITC, margin scheme is not possible. That notification 8/2018 is not applicable if ITC is availed. Okay. Then case scenario E, acting as an agent of service provider to the manufacturer, Messrs. Auto Drive purchase a demo vehicle from the manufacturer to provide test drives on behalf of the manufacturer, and GST charge 2,16,000. After 1 year, the company sells vehicle for 8 lakhs. Can they take ITC? No, because they are not engaged in further supply. You got it? For dealer only that ITC on motor vehicles, which is demo vehicles available, not for the agent. The agent who facilitates this test drive will not be eligible, only for the dealer. They are not selling. So acting as an agent, dealer is not making further supply, only providing test drives as agent. They can twist this point like this. That's why I have given there that ITC allowed or not allowed? Not allowed. And what about the GST on sale value? 8 lakhs. Why 18.6 not applicable? Why 18.6 not applicable? Because ITC is not availed. If ITC availed, only 18.6 will come. ITC not availed. So GST on sale value. Again here, suppose if they give WDV, can we go for margin scheme? Yes. Yes. So therefore, in this place, that is scenario C and scenario E, scenario C and scenario E, if WDV given in question, only in these two scenarios, not in scenario D. Why not in scenario D? Because in scenario D, ITC is availed. In scenario D, ITC is availed. So margin scheme not applicable. So if WDV is given in question, then GST payable on margin, in brackets notification number 8 of 2018. Clear? So good, 9 questions we did, and we will meet tomorrow. The remaining 41 questions are there that we will discuss, and tomorrow we will have class at 9 o'clock morning, not night, morning 9 o'clock, Sunday. Okay, 9 o'clock we will have, 9 to 1 or 2 depending upon the time. Till the time we complete this, we will take it. Okay, thank you. Same place.